stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynG.org for more details. CFA Society Nigeria, making finance a force for good.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Good morning, everyone. Welcome to the second day of the revision bootcamp for CFA Level 1 candidates organized by CFA Society Nigeria. Yesterday we started the program. Today we have the other 5 modules that will complete the total session. We're starting with equity investments today. After that, we have quantitative analysis. Then thereafter, fixed income, corporate issuers, and another model. But before I hand over to Abiola Ahmed to take equity, I'd like to say a very big thank you to a set of stakeholders that made this revision possible. And those are sponsors, 3 institutions, New Frontiers, tuition providers, First Quartile, and BRATIMS. While BRATIMS and First Quartile are located in Abuja, New Frontiers is located in Lagos. Without further ado, before I even hand over to Abiola Ahmed, I'd like to know where everyone is dialing in from. If you can drop that in the chat box. Let's see where all our candidates are dialing in from this morning. Yeah, I can see Lagos, Kaduna, and different other places, even outside of Nigeria, Abuja, and every other place. So we welcome you, our candidates, and we'll want you to take advantage of this opportunity. We want you to pass. Your success, like those faculty, those facilitators said yesterday, your success is our success. So at this point, I'll hand over to Abiola to take equity investments. Abiola, over to you.
All right, thank you so much, everyone. Good morning, everyone. Welcome to this session. The approach we take this one, please feel free to just talk about it. All right. So the approach we take is to take an hour to go through by those. The just highlight some of the area to institute visually purpose and take second go to the first questions. Go to the chat.
Bella, we can hardly hear you.
Okay.
I think your network is having issues. Maybe you need to reboot or dial out and come back in.
All right. Is this better? Can you hear me now? Hello, can you hear me?
Yes, we can.
Okay. All right, just to do a recap. I said we'll take an hour to notes, then second hour to go to questions. Go through market management structure. Really, what the functions of the financial system, and go back to what we learned quantitative methods. What we're trying to do here is move money through time. The the folks on the excess money side want to save money for future production, and the other stakeholders on the deficit side want to consume today, then they pay back in the future. So the function of the financial system is to actually make intermediary make these two people, this set of people meet, moving money through time from computers to the consumers.
Hello, Abiola. I'm
Yes,
sorry I have to interrupt. Your candidates are saying the audio is extremely bad. I don't know what you need, the adjustments you need to make so that it can come out clearer. Equity is a very, very important module for level 1. Thank you.
no, let me restart the system. Let me see that.
When is Abiola back?
Yes, he is.
Abiola, are you able to restart now?
Yes. Can you hear me? Is it better?
Yeah,
Absolutely. It's a lot clearer now. It's a lot clearer now.
All right.
All right. Over to you again.
All right. Thank you. So I'll share my screen again now. All right. So I was saying I will go through this content is will take an hour for the through my notes, then the second hour to go through the questions together. So we'll start with the market organization and structure. Right. So, brief function. Why the financial system? And we all know this serves as financial intermediary, right? Moving money through time and also letting the two sides of the market meet, deficit side and the surplus side. So also, what is the interest rate? This is, when we look back at that demand and supply curve, the price of money that clears the market, really, that clears the demand, and at the point where the supply of monies are willing to give that money out. So interest rate that determines the market prices of money and also that clears the market between the demand and supply. Also, function of the financial system is capital allocation, right? Capital allocation speaks to which part or what is the function or the use of money that gives the highest return or the highest return for the use of capital, right? So imagine if you have two issuers coming to market, says, I want 5 billion to set up a solar farm, and that says I need 5 billion to set up a manufacturing firm. So that capital allocation, and probably the market has 5 billion. So you need to then make the judgment around who exactly should I extend this 5 billion to. And that's the function of the financial system also. So also we look at the classification of assets and markets. Right? Financial assets, we have securities. You look at your bond, your stocks, the equities, right? Derivative contracts, currencies, right? Then you see the real assets, the real estates, commodities, bamboo, farm, art collections. And also, when we talk about types of markets, you have the primary market. We all be familiar with this now, given the rave of the moment around banks trying to recapitalize, right? So in the primary market, what happens is that the exchange of securities for money, the use of proceeds or the proceeds from such exchange goes directly to the issuer in the primary market, right? So I bought into one of these banks' primary offer. The money I'm using to exchange for that shares that they are giving me goes to the bank directly. That's the primary market, right? We have the IPO, initial public offer. We have the public offer, secondary offerings like the banks are doing now. And also we have instances of private placement, select investors looking at a particular issuer and making that investment. In the secondary market, what happens in the secondary market is just exchange between two other investors, right? The cash generated in that transaction will not go, or usually will not go to the issuer, right? Unless the issuer that is trying to do the secondary purchase. So you have this happening in the exchanges, our NGX. Also, it could happen in the over-the-counter transactions. So we have a particular dealer looking at this and say, I want to sell a block of shares. So types of financial intermediaries, you have the broker, dealers, exchanges. Right? Brokers basically will not hold inventory, right? just seek a buyer, seek a seller, connect the two of them, and a spread and move. Dealers take opposite position of a trade, so they sell out of their own inventories. And we also have an exchange. Exchange is just a marketplace, right? Connecting or making a platform available for buying and selling to occur. Also, we have securitizers, financial engineers create securities out of assets, right? We have the mortgage-backed securities, asset-backed securities. And probably we'll do more of this when we walk through derivatives in the curriculum also. Depository institutions, right? These are the institution that holds these certificates, the securities depository. So you have those shares that have been deposited in these deposit institutions to hold in trust for the investors. Insurance companies, and you probably see what's the function of insurance companies in this space. So if we cast our mind back to 2008, the credit default swaps, these credit default swaps guarantee that a particular instrument will not default are being sold by insurance companies, the likes of AIG and the likes. So these guys also are the financial intermediaries. Also, your typical insurance that you also buy the general insurance. Arbitrageurs. So these guys actually sell securities, same securities, different markets, take advantage of mispricing of the same securities in two markets. Just think around securities that have dual listings. Imagine Airtel on NGX and also on London stock. So if you see mispricing, probably based on information lag, based on movement in FX, right? So arbitrage guys will just do purchase here, sell over there, the same securities, different market, right? We have the clearinghouse that helps with settlements, and also the custodians that help in holding all of these securities. So in terms of position and leverage, so we could have hedging, and it's very important for us to also understand what hedging means. Hedging basically means that you are trying to mute or your exposure to particular volatility, movement in price. So if you probably are a refinery, you need crude oil, or let's say an airline operator, you need aviation fuel for the running of your planes. You could do everyday purchase or every month purchase, or you could hedge your exposure to the volatility in the price of aviation fuel by having forward contracts 3 months, 6 months down the line. So you have actually hedged the volatility yourself. You've protect yourself from the movement, wide ranges in prices of aviation fuel down the line, right? So also we can have leverage positions. What leverage position means is your equity, you are loading more debts on that equity to acquire assets. That's why you see return on equity for leverage position is outsized your return on asset itself by the financial leverage. So sometimes this FL, financial leverage, is also called equity multiplier. So that's for leverage positions. And we'll probably have another discussion around margins, the initial margin that the broker or the dealer require you to post, and also when we have situation of margin call. So if you have post a 20% or 40% margin, so your equity in this total asset position is actually 40%. So what happens is when there is positive movement in the prices, good, everybody's happy. But when there are negative movements, the dealer also wants to protect themselves from you getting wiped out and then automatically becoming a loan position on their side and you walking away and not redeeming that loan off. So they want a particular price threshold in which when the price falls below that, they take a call and say, hey, Abiola, post more margins, post more equity into this position. If you don't, they quickly liquidate and get themselves out of that position before the whole equity is then wiped out and then eaten to their own money. So very important calculations here. The initial price multiplied by 1 minus initial margin. So imagine when this first one we said 40% equity, 1 minus 0.4 divided by the maintenance margin. So maintenance margin is the percentage in which the dealer says if you go below this price, if you go below this, your equity in this position goes below this point, I will expect you to post more margin. So usually comfort levels around 25%. So you have 1 minus 0.4 initial margin divided by 1 minus 0.25, the maintenance margin multiplied by the price, initial price. So when the price decline goes that low, there will be a call to you to post more margins. And when you want to post more margin, you have to post margin that will take you back to that initial margin, 40% of the position, right? Also, order execution, where the market order basically say you are taking the price in which the shares is trading for. Also, you have limit order. Limit order could be on your one side, limit buy or limit sell. So imagine your limit buy, you say, Abiola, I want to buy MTN stocks tomorrow on NGX. I'm willing to continue buying these shares up to 200 naira, probably close at 180, 190 on Friday. So I'm willing to buy up to 200. So my trade is get fulfilled up to 200. Any price below that. So once the trading price of the MTN shares goes beyond 200, I won't automatically the exchange or the dealer stop buying for me. No, that's limit buy. On limit sell says I have 1,000 units of the MTN shares. I want to exit this position, but also I'm willing to sell up to 180. So any order you see below up to 180, please just take it and trade that shares for me. So the dealer or the exchange, keeps selling my shares. Once it gets to 180, it won't trade those shares again. I mean, it will not fulfill any order to buy my shares at 175 because the limit sell is 180. Also, we have the validity of the order. So if you are placing an order, you say this order is valid for today alone. So that's day order. So imagine your NGX 10 to 230. So I want to buy MTN 200 a day order. That means by 230, if that order is not filled, it's automatically get cancelled. The other option would be cancelled, right? That means I'm willing to let my order be in the market until I come back to say I'm canceling. So that can transcend or go beyond a single day of validity period. Okay. So you have to move very fast. This is 9:30. Okay. Security market indices. Index. So index really is very important, especially in this equity market. Helps us. We're going to look at the use of that index down. But return calculation methods. First, we have the price index. That's the price only. What that stands of is only the capital gains that the investors enjoy. So I bought a particular stock at 20 naira, that's gone to 40 naira. Then for price only, I'm disregarding the dividends or interest that must have earned on that security over the holding period. So price only just look at the initial price I bought it and the price I'm exiting at, or the current price where you are public valuing the portfolio to calculate the price return. The total return index takes cognizance of your initial price, the price at which you are selling, or the price where you are trying to calculate your return, and also whatever dividends or interest, which you can just then sum up as income over the holding period. So I've highlighted the formulas in there. Very important for us to have that difference at the back of our mind. So index weighting period methods, we have the price weighted. So basically look at your Dow Jones, just basically look at the weighting of the constituent of that index is just on their prices. So based on their prices, we have equal weighting. So equal weighting says I want to have 5 securities in this index, in this portfolio or index, right? I want them to be equally weighted. So that means each of the constituents will constitute 20% of the entire index. So that's equal weighted, right? Also, we have the market capitalization weighted index. So your typical S&P 500 the top 500 capitalized companies on the exchange. So here we are looking at the number of shares and multiplied by their prices to get the market cap. And based off of that, you then do the weighting of the index. Also, just to have adjust for, the fact that you have 1,000 shares listed doesn't mean 1,000 shares is actually trading. What we've seen over time is the key promoters holding substantial portion of these shares in their own position. So it rarely trades. So because of that, then we then do an adjustment on the market cap and say, let's do a float adjusted market capitalization index. So we want to then adjust this number of shares, 1,000, for the actual number that is traded, usually 30% or 25% based on the regulator's prescription. Some can go as much as 40. So that's float adjusted. So what we are just doing here is just adjusting. So we know 40% of these shares, what is actually trading, multiplied that by 1,000. So that you get like a 400, which is total. That would then be the total number of shares that are multiplied by the share price. Float adjusted market cap. What's the use of this index? Reflects market sentiment. So you see at close of day, market sentiment is positive. Why? Because the all shares index has gained 5 or 3% in a single day. When the market is everybody's fretting, investors are spooked, you see market sentiment on the red. What is making us make that kind of statement? Because probably the all shares index has just lost 5% during the day, the single trading day. So the index reflects the sentiment of the investors. Where is the head of the investor lying on that particular day? Also, performance benchmark. So we have individual portfolio managers like yourselves that you have the mandate to track a particular index. So if I have a mandate in Nigeria to track the NSE 30, right? In that case, if I come back to my investors or subscribers and say I've done 5% on their investment at the end of the year, is 5% a good number or a bad number? You can't just make that call out of thin air. I'll then go look at the track that the index I asked you to track at the beginning of the year. If NSE 30 has done 10% and you have just returned 5% of my portfolio, that makes you a bad portfolio manager, right? Because you've underperformed the index I asked you to track at the beginning of the year. So, and that is why the index become a performance benchmark for portfolio managers. That's another use of that index. So we also, index measures the market return, the broad market return. So why you say the Nigeria Stock Exchange or the stock market in Nigeria has done 30% year to date? What are we tracking? It is that index that we then look at what is the point at the beginning of the year at 90,000. Now we are at 104,000, 110,000. So it's the measure of the market's broad market return. That's the use of index. So types of index, we have index that is hinged on a particular sector, right? We have the banking index. We have the broad market index or share index. We can have sector index like the energy sector and the like. So banking sector, we have the FMCGs, manufacturing. So index can be created out of a lot of things, right? So it could be based on sectors, based on all of this. So index management. So we have the index provider that also does the index management. What do we mean by index management? Basically, is to say, I've considered this index. Let's imagine our equal weighting index. I want 5 stocks in this index to have equal share of the index, 20%, 20%, 20%. At the beginning of the year, I can achieve that easily because as I'm considering those index, I'll buy what of stock A, 20% what of the portfolio stock B. But throughout the year, the price drifts. Some perform better, some perform better. So that at the end of the year, the portfolio constituents are no more equally weighted in the index. So the index provider then do the rebalancing. So that means for those ones that have enjoyed a good market price run during the year, I'll sell part of them so that I can, because now they probably now weigh 30% of my portfolio, reduce that weight by selling off those ones that they have underperformed. I buy more just to boost their weight back to 20%. So that's really what rebalancing means. Rebalancing them to the mandate I have on the reconstitution basically is removing some of the some concept of this index and replacing them with others. So imagine your S&P 500. The stock number 4499 probably has not done worse. And we have a stock that usually was on 510 on the league table before, but had a good year. And then it should be on this top 500 now. So reconstitution means that I'm going to be deleting some concept of this index and adding new ones, replacing the constituents. That's basically what you are doing in your constitution. So this can lead to a lot of buy and sell for portfolio managers that are tracking such indexes. Okay. Let's move it on again. Market efficiency. Right. Informationally efficient capital market. So it says that for us to tag a particular market, capital market as being efficient, informationally efficient, it means that the price that we are seeing on the exchange, right, reflects the full public information that we have about the stock. And also in times when there are new information, the price change fully and quickly and rationally reflect all available information, right? And you could see when we see something like the jobs number in the United States, the new inflation report, the new employment report, or the new when there statement around the NPR or the Fed funds rate, whatever it is, now the price of stocks changes very fast. It is that time measurement in which how long does it take the price to move to reflect new information that we can then use to track how efficient the capital market is in terms of information. So some markets are very efficient, 3 seconds, everything has moved. Some market, it needs a particular and that trigger, probably 2 days, 1 day, right? In a perfectly efficient market, you expect your passive strategy. Passive strategy is where you just buy the index, buy the broad market, put your money in mutual fund. You are not actually actively making decision around buy a particular share or don't buy one. You are buying the entire market. So a passive strategy should outperform an active strategy. Because why? For a passive strategy, you actually then you save yourself a lot of cost, commission on trades, buying and selling when you're actively trying to pick stocks, stock pickers. You then, when you're selling, you realize some capital gains, then that comes to capital gains tax. You avoid all of that if you are doing passive strategy, right? And also you then have to pay a portfolio manager that you have given that mandate to do active for you. So all of that, you save yourself all of that stress as a passive strategy investor. So that's why you say the market is perfectly efficient. The strategy that will make you the best value for your money is to go passive. Return on any security is an equilibrium return to compensate you for the risk you are taking on the future's cash flow. Right? So when you see some small cap stocks outperforming or having high historical return, right? It's basically rewarding investors for those volatility that you expect in their own cash flow compared to matured, big-sized company that we know that, hey, these guys are going to make this amount of money. But for small cap or for small securities, we are taking risk on them. They usually fail, right? And for me to be considered to take that risk, I need to also have outsized returns. Exploit inefficiency in the market. Active investment strategies can generate excess risk-adjusted returns. That's the alpha. To the extent that the market prices are inefficient, right? So basically, your active strategy guy is looking at stock picking, right? Stock picking is really saying that, look, I've done my analysis of this stock. It should worth 10 naira. Probably it's worth 5 naira now. So I'll buy it undervalued, right? And expect the market to move and converge to the 10 naira that I've seen in my own analysis, right? And that's excess positive return is what I'll then pass through to my investors as alpha in my own strategy. because I'm exploiting inefficiencies in the market. Some are actually just information traders, probably make a bet on, say, inflation will be more than expected. So if that is the case, probably sell some stocks that I know that are going to be negatively affected and wait till when the information is released. And then when market moved, I've traded off that inefficiency and I've moved them, make my own, capture my own value in that space. Measuring market efficiency, the time it takes for trading activity to cause information to be reflected in security price. Like I said earlier, information efficient market incorporate all this information in prices very fast. So how do we measure this efficiency or inefficiency? We do weak form market efficiency, forms of market efficiency. So we have weak form. So that weak form efficiency says that the price of stocks we are seeing on the exchange reflects all currently available past information. Past information will be your prices and the volume traded, right? Price and volume traded. So it says that means that if what you are doing as a technical analyst, looking at the price and volume to make judgment around momentum and the likes, you are not expected to make positive return, positive risk-adjusted return based on that, because the prices that we are seeing must have incorporated all of that analysis they are trying to do. Also, for semi-strong, says that the price you are seeing on the exchange reflects all publicly available information. So this goes beyond the price and volume. It then incorporates something like some other qualitative information, management capacity, and the likes. So if you are doing fundamental analysis, you taking all of this publicly available information, doing your cash flow statement, doing your valuation and the likes, you are not able to make any positive risk-adjusted return, right? But if you are taking your time to do fundamental analysis and making judgment calls on valuation and prices, you then believe that if the market is not semi-strong form efficient, right? Because you want to generate alpha based on just public information, which semi-strong form market efficiency says you cannot generate alpha from. The third one, strong form market efficiency, says we have both public and private information, and that's on the extreme as insider information, right? Then if you look at all of this and say, hey, passive strategy is even better, I cannot generate alpha, then what is my role as a portfolio manager? The role of the manager is in two ways. Diversification. So you want to take, and when we do all of this in the modern portfolio theory, portfolio management, right? You as a portfolio manager, your task really is to diversify, and when you look at diversification, it's basically generating the same amount of return while taking lesser risk of exposing your portfolio to lesser volatility and the likes. Diversification is your major role as a manager. Also, client management, relationship management, managing your client emotions, right? So those are the fundamental role for the manager. Also, we have some indication around market anomalies, calendar effect, general effects, all of that. Then behavioral finance, and this is all over more emphasis is placed on this in level 3, right? It speaks back to client management. A lot of people, loss aversion, right, says that, and that's why sometimes it takes a lot of time to actually sell off another performing portfolio. Loss aversion, the investors do not want to realize these losses. Also, conservatism, they really change their mind. Illusion of control, they look at the model and say, look, based on this model, I'm making judgment calls. Ignoring the fact that there's so much you can control in this market. There are a lot more variables than what your Excel can tell you. All right, let's move faster. 943. Overview of equity securities. Type of equities investments. We have the common shares. I wouldn't spend more time here. Preference shares behave like a debt, because it's a common stock, right? No voting rights, convertible. It could be convertible, right? It could be not convertible sometimes too. So we have the private equity, basically investing in non-listed entities, right? So share price is negotiated between the firm and investors, potential greater return for investors once the firm goes public. Venture capital investment in early life cycle, leverage buyout, take out debt to buy up existing equity on the firm, thinking of around driving efficiency, spinning off underperforming entities, subsidiaries, right? To pay back the debt and also then generate a lot of returns for the equity. So even though you are doing leverage buyout, you still have some equity composition in this, then you lay on that mezzanine finance, also some loans, and pay off all of that, and the residual equity then capture a lot of value created in that process. We have private investment in public equity, quick capital raise for identified investors. So you could probably see a bit of that also in all of these banks trying to raise capital. So do private placement. Basically, instead of coming to the whole market and say, hey, everybody, I have to do a lot of adverts, I have to come to SEC and do all of those things. I could say, okay, I've identified 2-3 strategic investors. I'll meet with them and say, do you like my bank? What's the potential synergy we can get here? They like the old page, and then they come in privately, do SEC and all of that. So it's much faster, less marketing efforts and all of that. So for these strategic investors, they capture growth opportunities, exit distress, and also in the case of Nigerian banks, satisfy the regulators' requirements to get few private investors to meet all the capital requirement. And also sometimes this purchase happen at sizable discount, because you need something to actually entice these investors to actually purchase buy this equity. So also we have the foreign equities, GDRs, right? Deposit receipts. Also can do direct investing in foreign entities, in equities. Risk and return characteristics of dividend equities, securities. So your return in the equity space can be in three folds. Yeah, the price changes, the capital gains that we talked about, dividend payments, the interim and the final dividend in the year. And also imagine if you have done this investment in foreign entities, you can also have gain and losses from movement in exchange rates, right? So you've probably bought some shares, convert your Naira to buy some shares listed on the New York Stock Exchange or London Stock Exchange. You probably change your Naira then at 400. Even if some of these stocks are underperformed in US times or in dollar times, if you then liquidate this position and bring them back to Naira, because Naira then have moved from 400 to 1,500, you may actually end up having positive return in Naira. So that's why we say an equity investor is also facing, especially when you do foreign investing, right? Facing the return in terms of gain and loss from FX movements. Risk, you look at the standard deviation of returns, volatility, and the likes. Market value versus book value. Book value basically is you looking at the balance sheet, saying what is the equity holding here, asset and liability, the remaining equity, that's the book value of equity. Market value incorporates one thing that's very important: expectation of the investors of the future performance, your growth prospects, your differentiation in the market. All of this is part of why investors might want to give you a price higher than the book value of equity. All right. Look at cost of equity or the investor required rate of return. So what exactly is the cost of equity? Basically, this is talking to the return expectation of the equity holder. So and you see this reflected in discount rate. For on the debt side, on the fixed income side, basically look at the interest rate, the coupon rate, to look at the cost of debt. On the equity side, the investors will look at what the required rate of return, and that is what they are going to use to discount all of the future cash flows to come to the price they are willing to buy your shares today. You have the accounting return on equity, total return that is earned on the shareholder book value of equity. Okay, we need to move faster. Company analysis, past and present. So if you look at a typical research reports, look at the analyst valuations, speak to the analyst valuation, and also look at speaks to the investment recommendation, buy, hold, right, or sell. So we look at when we do our research, look at the operations of the business, the transaction, and also the valuation. Business model. Basically, you're looking at what is the business case here. How does this business generate value, right? And these are key drivers that will affect the income statement or balance sheet, right? Operations. Are these guys operation efficiency? Are these guys coming in with new products? What exactly is end to end? How to generate money of this particular business that they are doing or intend doing? What are the revenue drivers? Right? We have the total 5 forces, the SWOTs, the strength, weakness, opportunity, and threats. And I highlighted some formulas here which are very, very important. Operating profit. So look at operating profit, look at the quantities being sold, price minus variable cost, and then the fixed cost. Contribution margin per unit of this, look at the price minus the variable cost component. So you can see questions asking you for the contribution margin, questions are asking you about the operating profit. Very important for you to note all of this. Degree of operating leverage. Yeah, practically speaking to how much, if you look at the cost structure of a business, how much of the cost is split between the fixed part and the variable part, right? And you know your fixed cost really change. The variable cost is what changes that you can easily adjust based on what you are selling. To cast your mind back to the cost of goods sold, right? If I'm witnessing slow growth, I probably just order or say put a stop to amount of quantity of the input I'm ordering. But I can't quickly just exit my head office or change my light bill or lay off staff as such. But even so, some of these things, some of the fixed costs at long run can change to variable cost. But in the short term, usually rarely change, right? So the degree of operating leverage is looking at how much of the cost structure is actually fixed compared to what is variable. So we have the percentage change in operating profit based on the percentage change in sales. What we expect as a manager is when there is change in sales, especially when it's declining, your cost structure actually should reflect this very fast. But if a larger percentage of your cost structure is actually fixed, then there are limits to how much of these changes you can quickly react to. On the downside, it works like that. On the upside, it helps you, right? Because if you are experiencing very high growth in sales, your fixed cost is fixed, right? But if you can then sweat that fixed cost, it makes more sense for you, right? Because you can then, on the back of that one factory or 100 staff, you can generate even larger amount of revenue without their salary changing very fast. So it works on both sides. The degree of operating leverage won't keep input or metrics you keep in mind. Also, degree of financial leverage, very important also, right? If you load up your process with a lot of debt, the servicing those debt is fixed, right? When your top line, the revenue is changing very fast, let's imagine the revenue is declining. You're not generating so much revenue, but the debt service, the banks will still collect their interest payment at the end of the month, or end of the quarter or the year. You can't really change that very fast unless you stay. On the long run, you can talk about renegotiating this debt contract and the likes. But financial leverage, you look at the percentage change in net income over the percentage change in the earnings before interest and tax. So those are 4 key metrics I think we have to put our eyes on for this exam in this space. Industry and content analysis is much broader in sense of how do we define industry classification. I know we have the one that the MSCI does. We have the survey on the industry size, and also all of these FC where we want to advise clients on market entry and all of that. What are the existing competition? What the other competitors? What stage are they at in the life cycle? Even the industry you are entering, what stage it is. Imagine someone that wants to enter into the banking sector, which fairly close to mature or compared to a client that want to come into fintech space, which is still at the early life cycle, experiencing very high growth. Right? How do we examine the external forces? We have the personal analysis, look at the political, environmental, social, and the likes, technological influence. Five forces, like we said earlier, threat of entry, threat of the existing players, power of supplier, power of the consumers, and the likes. Also, the SWOT, we are all familiar with this. Analyze companies' competitive strategies, cost leadership, right? Very important. So there are two ways in which you can make your net income go up. Either you drive up the revenue and make your costs remain the same, or the revenue remain the same and you then drive down your cost. So cost leadership is one of the metrics that you need to look at when you're analyzing a particular company. So look through the banks, look at something like the cost to income ratio to understand how much efficiency is in this banking process, right? Differentiation, look at your Apple and other devices. You differentiate the product, you can then charge a premium on that differentiation, right? Also, we have companies that just on focus. So when you do focus, look at your division of labor. When you do focus, then on that particular product, you are putting all your energy, your R&D and the likes. You can then drive up even more efficiency, drive up a lot of value add, because that is your prime focus, and you put in much more resources in developing product in that space. Okay, forecasting. I know this forecasting, a lot of that is done in the other accompanying module that CFA has given us access to. The 3 financial statements is something I will encourage everyone to spend some time to do if you don't know how to do this yet. So you could do the 3 statement model and also build on that and do evaluation. Right? So how do you do a typical forecast? Right? Take top down. Okay, so look at, can you still hear me?
Yes, sir.
All right. My screen is out, so I'm trying to be sure that this is still fine. So I'm trying to put up the screen again. It says connecting, just a minute. Please, can you see my screen now?
Yes, sir, we can.
All right, thank you. So apologies, I lost my network earlier. Right, forecasting, right? You do top down, right? So I usually will start with the income statement, do some of that, then go to do the balance sheet, then you do your cash flow statement last, right? So top down, if I want to focus, and usually you do those line items. For your income statement, you do the revenue, do the cost of goods sold, do the gross profit margin, then do the SG&A. And each of these line items, there are peculiarities on how you forecast each of these line items. So let's look at the revenue. How do we do that? We look at the top down. It will be top down, right? So let's say a particular company, FMCG, first, these guys are facing the entire macro. So look at what is the macro expectation. What is the GDP of the country in which they are selling their product? What's GDP? So GDP's growth forecast says we expect 5% and another 3% the second year and the likes. So rarely it is that you then sell more than these guys. So you can then moderate your projection for revenue growth based on this macro forecast also. And this, your judgment will come from the firm's performance within the entire macro, right? Else, you could do the bottom up, right? If you want to do a bottom up, let's imagine a particular apparel, someone that sells clothing items. I can first say how many outlets do they have across the country? What is then is the sale per outlet, and then aggregate this upward to get the revenue for the business. All right. I could do that also. I could look at the average selling price and against the total expectation of how much product they expect to sell over the years, and then multiply this through price and volume to get the revenue. Okay, for recurring and non-recurring items, analyze non-recurring items as a standalone, right? So why? Because we don't just want to assume that a non-recurring item, let's say one-time FX gains like the banks have seen, will occur for the next 5 years. Will keep occurring every year for the next 5 years, so that we don't then overestimate the numbers for their net income because they've experienced foreign exchange gain in 2023. We don't just project all of that flat for the next 5 years. So non-recurring items such as one-time items like FX gains, like one-time judgments, settlement of a court case. So we don't over-punish or overestimate their income statement, right? Analyze those non-recurring items as a standalone. We understand cost of goods sold. It could be one minus the gross margin estimated multiplied by the estimate of the future revenue. We could do this. Some will approach this and say, let me estimate cost of goods sold as a line item. Then deduct the revenue from this, deduct the cost of goods sold from the revenue to come to my gross profit. So there are typical peculiarities that we have to actually as analysts account for when we are making this forecast. And so I encourage everybody to take that course if you have not done this before. SG&A, selling and general administration expense, we just adjust this for inflation, right? Working capital, receivables, inventory, and account payables. Also, usually we do this around inventory turnover, receivable turnover, payable turnover. Then also look at the days of sales outstanding, days of payable outstanding, days of inventory on hand, to actually make a forecast around these numbers. Very important for us to know how to do all of these things. Yeah. Capital investments, acquisition, deposition, depreciation, amortization. So usually you look at the management guidance around this. What are the capital investments they intend to make also going forward? Capital structure, basically looking at how you finance your capital expenses, right? Amount of debt, amount of equity. Usually management guidance will also help us in this, or we look at the historical and see how they finance previous acquisition and the likes, or capital expenses. Also helps us for us to do scenario analysis, right? It's just not supposed to be a single one data point. Let's capture if there's significant upside, the best case, worst case, and the likes. And this particular session is usually very, very hands-on. So it helps to know how to do these things on Excel before approaching the exam. So equity valuation, this is the last topic in this session, I guess. All right, so concept and basic tools. This is a preamble to what we do in level 2, right? Level 2 usually a judge level for valuation. So it helps us if you understand all of these concepts and basic tools before approaching level 2. Dividend split and repurchase is considered for investing based on valued differentials. So, and very important when I'm making a judge about valuation, I say when you come to valuation, I say that the price, based on your own analysis, the price should be 10 naira. But this stock is traded at 9 naira 50. Do you want to make this trade or buy this stock because of the 50 kobo difference you are seeing? And that's where the materiality concept comes in, right? So you then value in and say, look, if I want to purchase this stock, there is commission to be paid, there is broker fee and all of that. If all of that, we wipe out that price differential, maybe it's just best not to purchase this. All right. So we want to actually assess the materiality of the price differences that we are seeing before actually making the investment decision. Also assess your confidence evaluation model that you have done. Cast our mind back to that other behavioral finance thing where we talk about the illusion of control. There is so much you can capture on your Excel sheet. With so much other variables that are extend beyond what you are seeing on your assumptions on the valuation model. And your model is as good as the assumptions you are putting there. So that is the confidence in the valuation assumptions that you are putting. Depth of researchers following the stock. So it's better if you have a large following in a particular stock so that you have that wisdom of the crowd. And also the last point, very important, believe in convergence within the investment time horizon. So you are a portfolio manager, someone that's giving you money and say, look, I'll come back for this money in 1 year. An analyst just told you that this particular stock is mispriced. There is 2 naira or 20 naira price difference capture that you can, let's say 20% upside. But then my question to the analyst would then be, when do you expect this convergence to happen? If I enter this stock in January and I don't see this convergence happening, I don't see any market event that will trigger the convergence before the December when I will have to make a return to my investor, I might not decide to buy. I might decide not to buy, right? Because if I go in, I can quickly enter the value trap, or I buy this stock, it remains at that particular price. The upside is not captured before the investor will come back for their money. So you need to assess your belief in the convergence within the time horizon. Also, we have the DCF model. These are the model for valuation, dividend discount model. We have the multiplier models, basically looking at the market price, and you have the asset-based. And these are all have their own peculiarities. For companies like real estate, like manufacturing that have a lot of physical assets, you might want to use the asset-based models to do their valuation. For companies that are asset-light, future growth prospect is high. You want to look at the dividend cash flow model, right? For companies that have a lot of comparables, so if you look at the law of one price, similar products should sell for similar prices. So if you have a lot of comparables for a particular company, we want to go with multiplier models, just so you see, and we have a lot of historical transaction in that space. So they are prepared to these models or not to use them. Discount cash flow model is just looking at how do we do this. Look, projection for the cash flows, discount them at the required rate of return for equity to get your price for today. And you can look at the multi-year holding and see all of this. Another thing we look at is what the cash flow you have with discounting can be dividends based on the peculiarity of the company. It can be free cash flow, right? For companies that don't have history of paying dividend, or usually will not pay dividend, how do we then do the valuation? We want to look at the free cash flow. Free cash flow is looking at the amount of money that will be distributed to the investors, even though they are not distributed. Right. So formula for all of this is right here: net income division and increase in what capital, fixed capital investment, and also look at the debt principal. So these formulas are very important for us to know as we approach the exam. Then another question would be, how do we estimate the required return for equity? So we have a lot of models for this. We have the farmer friends, we have the one. So what we have here is a one model, which is one factor model. The factor we are looking at is the market risk premium. Right? So, but we can have extension of this, which we are going to see in level 2. But look at the capital asset pricing model, look at the risk-free rates plus beta. Beta is looking at the sensitivity of a particular stock to the general market, right? And then the market risk premium, the market return minus the risk-free rate. Also, for public company, you can also use your discount rate as you can get your discount rate by looking at the equity premium plus bond yield, equity premium plus common bond yield, and the likes. So, preferred stocks, while you prefer stock, look at the preferred dividend divided by the cost of preferred dividend. right? The Gordon growth model is based on some assumptions, valuing stable and mature companies, history of dividend growth, history of dividend payments, non-cyclical, and dividend paying firms. So all of this need to be at the back of your mind before applying the Gordon growth model. So formula also is highlighted here, very important. Net step dividend divided by the cost of equity minus the growth rate. Very important for us to understand that time value, how we draw our timeline. So a lot of people make mistakes in using the current dividends. The formula here says next year dividend. Very important for us to look at that. Also, assumption here is that the company is mature so that they have a constant growth rate for the forecast period that you are making this analysis on. Cost of equity also has to be greater than the growth rate. Another question we'll see over time is when the exam asks you to estimate the portion of the value due to growth. So how do you capture this? How do you estimate this? You first do your Gordon growth model with the advised growth rate. Do your valuation again based on zero growth. The difference between these two values is the estimate is the portion of the value due to growth. So very important for that. Have that also. Growth rate of dividends. How do you calculate this growth rate? That G, that formula. It could be 1 minus payout ratio multiplied by the return on equity. That is sustainable growth rate. Or you could do another variant of this formula is the retention rate multiplied by return on equity. Also, you could look at the firm historical growth rates, the industry median growth rate, do some analysis. Judgment around these numbers is also very important. Multi-stage growth rate, right? So when we have companies that right now they are in the early phase, but we know that the growth rate they are experiencing now will not last forever, right? Based off on that, we could have the multi-stage dividend growth rate model, whereby you look at the rapid growth phase when you are experiencing the 20% growth rate. The transition phase, it is then moderated to like 7.5, and the constant growth rate, which is now probably at 3. Then you value all of this across these timelines to get the particular prices that you, or particular value of the stock. Relative valuation measures. So when we look at the market for guidance, price to earnings, price to cash flow, price to sales, price to book value ratios. So we look at the comparable companies' numbers and then apply that to this our own company's earnings, cash flow, sales, or book value to come to the particular price, which is just a price that's a fair value of that stock. Multiple based on valuation on fundamentals. So we have the price, current price, divided by the forward earnings. So we have the leading P ratio. These are the P ratios, right? So when we say justify P, that is justified means that the price we are using is the current share price. Right? Trailing can be because we are using the current earnings. Leading can be because we are using the future earnings. Very important concept here, dividend displacement of earnings. Says when the company has large dividends, right? The payout ratio is high. We do not expect that company to also report high growth rate because that dividend you are distributing to your shareholders will rob you of retained earnings, which you can plow back to do organic growth for your business. So very important to also have that at the back of our mind. Enterprise value formula is also important. Market value of the shares, market value of equity, market value of debts, minus the cash. Asset-based valuation models, like I said earlier, it's peculiar to certain companies, right? Financial institutions, because most of their assets are liquid. Very important for us to note that. Also, natural resources firms, because what they are trading, like your ExxonMobil and the likes, is the oil in their reserve. So we have those kind of reserve-based valuation for those kind of companies. Equity value, fair value of assets, and fair value of liabilities that then come to the equity value for such. How do we complete fair value of asset? And we do that in our FSA, right? Efficient values, inflation adjusted, and we'll also look at the estimated replacement value for this. Very important for us to look at the advantage and advantage of each of these category of valuation models. They have their own peculiar advantages and disadvantages, like we have noted earlier. Dividend discount, discounted cash flow model. If I want to base off on dividend alone, I might not be able to use it for companies that don't pay dividends. So all of those peculiarities might be the tiny questions that might come out in our exam. All right, so that's the run through of my notes. I'll let us take questions and also look at the question in the curriculum itself. I'm putting up the curriculum itself now. So I'll just pick questions at random. People can just put in their answers. So let's start from 1. So this guy has designed a sophisticated forecasting model which predicts movement in overall stock markets in the hope of earning a return in excess of fair return for the risk involved. Okay, someone says, can you explain rebalancing again? Kemi, right? Rebalancing, like I said, it's, if we have said the index provider says this my index is going to be equally weighted. Demand is this index is equally weighted index, which means if I have at the start of the index, I have 5 constituents. These 5 must sum up to the total. So that means each of these stocks must have the weight of 20% of my entire index, 20% each. Now, based on this, I've bought each of these stocks at, let's say, one for $5, another one for $20. But during the year, the price movement varies. Some will outperform, or some will have increase in prices, some will have reduction in their prices, decline. So at the end of the year, when I'm revaluing my index, because those that have experienced price gain over the year, they become overweight in the index now. Why? Because the price have moved from 20 naira to 40 naira. So instead of them being 20% of the portfolio, they are now 25 or 30%. So they have robbed the other guys of their position or their weight in the portfolio. So what I will then do is to sell off. Rebalancing means that I want to go back, I want to achieve my 20% allocation for each of these constituents in my portfolio. So the one that are overweight, I will sell off those positions. The one that are underweight, I will buy more of those positions. That's the balancing. The balancing is coming back to the initial weight that we set out with, or we have actually said that this index will report. Kemi, is that fine? Tolu says, explain forecasting of working capital. Even though we might not be able to get through all of that on this. So that's why I advise us to take that module which the institutes are giving us access to, that 3 statements module. So how do you forecast working capital? Remember, your working capital is current asset minus current liabilities. What is your current asset? You have your receivables in there, your inventory in there, your cash and the likes. And then the liability, you have your payables. So usually we will not do the cash part. So for your, let's say, the inventory. So if you want to forecast this inventory, what do you first do? First, look at your inventory turnover. How do you get to the inventory turnover? Cost of goods sold, then average inventory, right? Once you do your inventory turnover, then you look at your days of inventory on hand, which is going to be usually 365 over this inventory turnover, right? You get this day, right? So that you can And then you then say that going forward, are we going to maintain this, let's say 30 days inventory on hand? If I then forecast that for the next 5 years. So based off of that, I can then, in my forecast year, I can generate the inventory turnovers for those forecast years. Once I then get the value for the inventory turnover for these forecast years, I can also then go back and generate the value for the average inventory, right? Because average inventory is basically my inventory turnover that I've computed here, then divided by the cost of goods sold. I can probably, say we start with the income statement. I know the number of my cost of goods sold for the next 5 years. Then I know the inventory turnover. I want to forecast the financial item of inventory, right? I then say the average inventory will be the inventory turnover, the cost of goods sold divided by the inventory turnover. I can use that to do this. So same way I can do the same thing for receivables. Receivables is your revenue turnover over average receivables, right? Then you do your days of sales outstanding, right? 365 over receivables turnover. So once you have days of sales outstanding, this is what you are going to decide as an analyst and say, is this of sales outstanding, is it going to remain the same for the next 5-year forecast period? If management say that they are intensifying efforts to declare this of sales outstanding from the current 65 to 30 by year 5, I can do linear interpolation and say this will be 50, this will be 40, and this will be 35. After doing this of sales outstanding, I then go, I want to go to my receivables. That's the number I want to generate. Receivable will be your revenue that you must have forecast for in the income statement divided by this sales of sales outstanding. So do we get that? Tola, are you fine? So that's basically how you do the forecast for the working capital items. You apply the same method to your payables. Thank you so much, Tolu. Okay, so let's quickly connect this. All right, we'll look through the questions again now. Just so that we can pick. So who can help? What's the answer for this question 1? C, information motivated trader. So the guy uses the model to decide whether to buy, hold, or sell the shares of the index fund that aims to replicate the movement of the stock market. So information. So we are all going with C, right? And like we said earlier, we have the hedger. The hedger is trying to limit their exposure to variability of volatility in the market. An investor is here for the long term, want to buy now and wait it forever. Your Warren Buffett, right? That's very good gift. Information motivated trader wants to capture value, short-term value in the market due to mispricing. And you can see this guy has just built a model and then want to capture those kind of movements. Question 7, I'll just pick questions at random while we just look at the answers together. Oil and gas exploration company offering 30 million shares to public at 45.5. B, very good. Any contrary answer? Good. B, because that money will go to this oil and gas guy. They are offering secondary offer. So, and all of this answer will come to us very quickly based on the bank's capitalization that's happening in the market right now. I guess GT Bank is selling at 552. So such a coincidence. All right, thank you, Kemi. Let's move on. Question 12. Forward contract is limited by some problems. Which of the following most likely one of those problems? The usefulness of forward contracts. Yes. Once you enter the forward contract, difficult to exit. Entry to forward contract requires long party to deposit the initial amount. No. If the price of underlying asset moves adversely from the party of the long party, ready payment must be made. No. So you can see that option B is speaking to futures. The futures market that you put in initial amount and then there's settlement every day by the central counterparty. So thank everyone. Option A is correct. Once you enter a forward contract, you cannot exit easily because these are forward commitments, right, over the counter contract. Okay. Good. Let's move fast. Question 17. This guy worked for an hedge fund specializing in finding profit opportunities that are a result of inefficiency in the market for convertible bonds. Price inefficiently. What's the answer here? So this is strategy here. Remember when we explained hedging earlier, we have explained hedging earlier. You are trying to limit your exposure to a particular variability in the market. Very good. B, arbitrage. This guy is looking at two securities that have the same, almost similar peculiarities and trying to look at sell and buy at the same time. So for arbitrage, the trade have to happen at the same time. So let me see where that is. So can you see this word here? Simultaneous purchase. That's the keyword there that will lead to the answer B. Simultaneous purchase. I told you, arbitrage guys will not hold anything on their inventory. Sell this, buy this, net it out and get a margin and get out. All right. Okay, let's move on. Let's look at second topic, question on 343. Question 1, security market index represents, what's the answer here? Index, what does an index represent? Thank you, Ozazi. Thank you, C, that's correct. Question 5, when creating security market index, must first determine what? A, very good, target market. Where do you want to do? Then you can then settle them. Let's do some computation here. Question 8. The price return. Remember, we said price return focuses on just the price movement. So, what's the price return for the index here? Also, note the index is price weighted. Price weighted index, use that initial price to determine the weight of each constituent. Then look at the price return, multiply that price return by the individual weight to get the index price return. All right, I trust Pfizer. Now you're having conflicting answers. So B. Everybody has to do it. We are going to be forced to complete this in ourselves. We have A, B, C. Okay. Let's just do it together quickly. Now that we're having conflicting answers. So let's solve this together. First, compute the weight for A, B, C. Total price at the opening is 60, right? So that A will be 10 over 60, 1 over 6. It will be 16.7% of the index. The other guy is 20. That would be 33, right? 33.3. So we are computing the weight first. The last guy will be 50%. Oh, sorry. Sorry. Question 8. Thank you so much. We are supposed to do question 8 too. Right. Okay. Let's do question 8. Okay, price weighted. So let's go again. 25, 35, 15. We are doing question 8, price weighted index. Please. 60, that's total of 85, is it? 75. Based on this, let's compute the weight for A, D, and G. 25 of 75 is 33.3. 35 of 75 is 46.7. The last one is 15 divided by 75, 20%. Then you now compute the price return for each of these guys. This guy moved from 25 to 27. So that's 8%. The other one moved from 35 to 25. That's a loss. 28.6%. The other guy is 16 over 15. That's 6.7%. So you then compute this multiplied by this. So 33.3 multiplied by 8. 8.33.3. 8%, sorry. So this gives you 2.7. The other one is 46.7 multiplied by 0.286. So this is minus 13.3, and the last one is 2.7, 1.4. So let's add this together. 30.3 plus 2.7, 9.2. So the answer is B. Do you all agree to this now? So first, for this price weighted, first compute the weighting. Thank you so much, Rayodua. Compute the weighting first. After the weighting, then you modify the return by the weightings. Okay, someone said we should do the equal weightings too. I don't want to spend so much time here so that we can do the actual valuations. But let's look at this. Question 7 says, so equal weighting index. So that it is even much more easier. We know that we don't have to compute the weighting. We just know that the weighting is 33.3% for each of these. In fact, the easiest way you can do this is to find the price. Okay, we are looking at total return. So find total return for all of this, for the 3 of them. The answer you get divided by 3. That will be the total return for the index. Can we do that? Is it clear? Remember, our total return formula is the initial price minus the current price minus the initial price plus the income that we earn over the initial price. So let's do this. Compute the total return for all of them. Sum it up. Divide it by 3. Who can tell us the answer? What's the answer? B. Amaka. Oh, Blessing said C. Rayolua said C. Okay. C. I think C is C. Amaka, please check your computation again. Everyone is getting C. All right. I think C is the answer. So let's move on. Let's move to another chapter, 384. Let's move on. Our time is almost gone. Great. Question 1. If markets are efficient, if markets are efficient, the difference between intrinsic value and market value will be what? Thank you, Joy. Very good. It will be 0. That means the price will reflect all available information and the price will reflect the fair value of that asset. The intrinsic value is the fair fundamental value. The market value is what the investors are willing to pay. All rational investors are going to pay the fair value of this in an efficient market. So the difference will be 0. Question 2. Intrinsic value of an undervalued asset is what? Very good. Greater than the market value. Very good. Question 8. Most likely restrict. So let's look at it. Impede market. Yes. Restricting the ability to short sell. So we can't take position on the downside. Thank you so much. This option C is very good. We have to penalize people that are trading insider information. A is our answer. Okay, very good, very good. Question 15. In a semi-strong market, what's the answer to question 15? B, higher. Very good, Blessing. Very good. Everybody's good. So, because I will not pay cost to management fee, I will not pay tax, I'm not liquidating. Also, I will not pay the commission on trade and the likes. 22. B, very good. Momentum pattern. What the technical analyst is trying to do, because in a weak form, you are not expected to iron any alpha doing all of this momentum pattern. Yeah, the fact you are doing momentum pattern says you believe that the market is not weak form efficient. Okay. This last one. What's the answer? Behavioral theory, loss aversion. C, Pfizer, thank you. C, asymmetry. Investors don't like the downside risk. The tail risk where you go lose money, they don't like that at all. That's the loss aversion we're talking about. Nobody will complain that they have outsized return where they're expecting 2%, they earn 20%. Everybody's happy. But then it becomes a problem when you are getting negative return. Okay, let's move on. Overview of equity securities. Time is fast spent. Question 1, what's the answer? Common equity characteristics. Yes, no promise of dividend. No promise of dividend. Very good. Question 6. Provide mezzanine financing to early stage companies. Yes. Mezzanine financing. This one, they do require long-term commitment of funds, right? VCs can be with you for quite a while. All right. Question 9. Yes, the depository bank that holds their voting rights and trust for those investors, for the investors. Okay, let's move on. Question 16, least likely. Least likely, very good. Return on equity, very good. This is not good. You're not usually good to increase return on equity because what you are doing, remember your formula for return on equity is net income over equity, average equity. Once you go raise money, your average equity expands, right? So denominator is expanding. Well, there could be increase in the net income, but that is also a given. That's also is we are going to wait to see that, but it's least likely, right? Let's move on. So let's do the last question again. Cost of equity is a proxy for what? Very good. We should not make that mistake. It's not a maximum, it's the minimum required rate of return. Minimum required rate. Let's move on. 474. Company analysis. Yeah, this is very important. It's quite long. Question 1 says, most likely element of this guy's subsequent reports. So he has a summary of changes. Yes, that is the monitoring after you have issued a report. Change it to recommendation so that you could come back. Revenue was closest to what? 2019. So this way used to calculate the answer. What's perfect? Ola to see me. Ola, thank you. That's it. Your revenue for this is that book you get from customer. This 6%, yeah, of this over the 900,000. Okay, very good. Yes, who can help us with this? Cash conversion cycle, money out, money in. Cash conversion cycle. So let's calculate clean yards and old ships. Cash conversion cycle. We have the sales of sales outstanding, inventory on hand, payables outstanding. So just drop it in. What's the old ships cash conversion cycle? What is clean yard conversion cycle? Then which one is lower? Old ships, -17. Is it -17 or 17? Old ship 11. So 27 plus 12 minus 55. This was still outstanding, inventory on hand, payables outstanding. Yes, very good. Negative 16. Negative 16, that's good. Old ship is negative 16. Very good. Ola, good. 98.46 minus 40. So that's very good for us to understand that cash conversion cycle. Money out, money in. Very good. Joy. Lower. Good. Let's move on. Our time is almost out. 513. So an problem, which topic is this? Okay, quantitative analysis. Question 1, what's the answer? Alternate method of grouping complaints by geography. Primary listing. It's least likely. Look at this. This is a word here. Least likely. Least likely. Very good. B. Geographic composition of revenue. Sometimes we are always tempted to do that. It is look at location of head office and also where the equity is primarily listed. Very good. B is the answer. Let's move on. Question 3. Lower industry concentration. One with low product differentiation, service-oriented, global. You can't agree on this. C, B, I'm saying, oh my God, I'm saying ABC here. Lower industry concentration. One with low product differentiation. Okay, very good. So these are six pest analysis, the framework for identifying industry themes, level of industry concentration, determinant of industry profitability. No, pest will not do concentration. Very good. Industry themes. Industry themes. Because you're looking at the political, environmental, social, technology, and all of that. Legal and like. Let's do the last question. Last question. Risk of executing differentiation competitive strategy. What's the most likely risk? Yes. Prices premium becomes too high. Your prices out of the market, right? You are not competing based on price. So this is out of it. Desire for premium pricing among customers. This is good news, right? Basically, you are just at the risk of pricing yourself out of the market. Okay, let's move on. Prices for forecasting. Good. First question. You have 30 more minutes. Forecast object should be very good. C, please let investors know that this item on the report is a forecast, right? It's a very, very important disclosure item. You have to disclose, you have to disclose this. Question 2, management guidance. A, very good. Revenue is very good. Capital expenditures. So we know what plan they have to do. If says you are going to do more towards next year, all of those guidance. But if you are selling commodities, you don't have any guide, you can't give any guidance on the oil price, right? Because it's not in your control. If your revenue is sensitive to business cycle, you can't give guidance on revenue also. Because that business cycle can, even though you can see some trends, but it can change very rapidly. All right, question 5. Least appropriate. Somebody that is doing luxury item is entering the mass market. Yes, you can't use Historica again. These guys have left. He has left left is former base. Okay, very good. Let's do some calculation. Gross profit margin. Question 8. Gross profit margin. So what's the answer here? Selling price. So remember, start with your revenue. Revenue is price times product. Price times volume. Price, reduce the price by 5%. Then increase the volume by 8%. So what's the answer here? Gross profit margin. Revenue minus cost of goods sold. B. 42.6 by 182. So I get a lot of B's, 46.3%. 46.3%. Any contrary answer here? B. Okay, 46.3%. So thank you, Blessing. Thank you, Blessing. So you have and speak back to when we forecast our line items. Do your price, reduce the price by 5%. This is increase the volume by 8%. Price and volume give you the new revenue. The gross profit margin used to be 40%. So you can calculate the initial cost of goods sold, right? Then based on that, you do your gross profit margin. Gross profit margin from that. Very good. Final one, 609. Valuation, right? And usually, because these questions in valuation can test multiple concepts at the same time, so you expect much of the questions on this side. So a single question that can test multiple concepts, is something you should expect for your exam, right? So question 1, intrinsic value is 17 to 21. Market price is 24. What's this price? What's this stock at? Overvalued, yes. Overvalued. Let's go. Question 4. Most likely in present value model. Very good. Free cash flow to equity, right? Enterprise value, looking at the entire enterprise, price to free cash flow is multiple. Remember, present value model is a discounted cash flow model. Okay. Let's move on. Question 5. Book value is least likely. Operating word here, least likely. Thank you. C, very good. Because present value model is discounting cash flow entirely. Exclusively, sorry. Question 9. Question 9 is a true question. A, thank you. A, present value of future expected cash flow. All of these are actually part of the formula. For you to get the free cash flow, you must have consider your net borrowing. For you to get the free cash flow, you must have consider your capital investment. All right, good. Question 11, let's calculate this. So this guy is doing an offering, 4.8%, 25 par value, perpetual, non-convertible, non-callable preference shares, right? The required return on similar is 4.49, right? Then the intrinsic value here, preference share will be what? Very good. B, 26.7. Any other contrary answer? So we remember that formula to compute value of preference shares. Your preferred dividend divided by the cost of preferred dividend. The cost of preferred dividend is right here, 4.49. To calculate your preferred dividend, just do 4.8 multiplied by 25. You get the value divided by this 4.49. Very good. Last question. Our time is fast spent. Let me take a question. Question 20. The best model to use. Solve what? Somi, which question do you want us to solve? Our time is. Somi, can you? Which question? Question what? a young dividend paid that is just entering growth phase. Two-stage or three-stage, you're just entering growth stage. Remember, at that you're just entering growth stage. You do that high growth stage, then you moderate. Then you have the long term. Very good, three stage. Because this guy is just entering that growth stage. You expect that rapid growth phase, then the moderation, then the final long term growth. All right, I would like to stop here. I wish all of us success in the upcoming exam and in our careers individually. Thank you so much. Sami, which question is Sami saying? Can you question what? Okay. I'm sharing a file. So, okay, very good. This question Sami just putting up is our margin call price. Remember, initial price multiplied by 1 minus initial margin over 1 minus maintenance margin. So just look at that and solve this. All right, thank you so much, Mr. Yemi. I'm out.
Thank you very much, Abiola, for your time. We really appreciate. Next facilitator is going to be Oluwatoyinbo. She's going to be covering quantitative techniques. Toyin.
Thank you very much, Yemi. Good morning, everybody. I'll just share my screen. Okay, so I would like to get a feel of where we are, so I know the expertise in the room. Give me an 8 if you've probably solved quants like twice, and a 5 if you solved it once, and just don't respond if you haven't gone through everything before. So I have an idea of what to focus on and where we'll need help. Okay, so I see 4s and 5s means we'll try to do a deep dive. So we have about 11 models in quant, and okay, so let's see how far we can go. Okay, so as Yemi introduced, my name is Oluwatoyinbo. I'll be taking you through quants. So the reason why I'm here really is to help you pass your exam. So let's keep that in mind. I would also appreciate if you have your calculators handy and maybe you need a pen or something so that you can jot down, because we're going to be solving as we go along. So we'll start from the top, rates and returns. I will speed up on areas where I feel you should be able to handle and focus on the ones you want me to. Please, I'm monitoring the chat, so tell me if there's anything. Are the slides moving? Are you seeing me on rates and returns right now? Oh no.
Still on the first page.
Still on the first page.
Slide.
Okay, so let me reshare. Let me reshare.
And it wasn't on presentation mode.
Okay. Let's try that again. Okay. All right, so this is where we were. We're discussing rates and returns. So I'd like to speak to concept first, and then we'll deep dive into what the material says. So if anyone has done MMM before, they understand what return is how much do I put in and how much do I get out. If you are playing the stock market, you also know what returns are. How much do I put in, how much do I get out. For risk, like I mentioned, MMM, is very risky. If the Ponzi scheme falls apart when you put money in, you tend to lose everything. If you stick with FGM bonds, it is almost riskless because chances of the government defaulting is almost zero. So that's basically the concept of risk and return. So interest rates is if I put in 10 naira, how much, and I say I'm compounding in by 5%, how much do I expect at the end of the year? 105. So that's basically what it is. The holding period is how much do I get per time? So per time, what are you measuring? Are you measuring daily? So if you trade in FX, you might be measuring daily or hourly. If you trade in stock markets, you might want to measure at the end of the month. If you're doing bonds, you might want to see what your returns are over a specific period of time. So that's what the holding period speaks to. Formula for holding period is ending value minus beginning value plus any income you got in between divided by the initial value. I don't think we'll have any issues with that. Money weight return is you're using cash flow, right? So there are different measures of return. I want to see how much I put in and how much I get out at the end of the day. So if I'm investing, for example, and interest rates in money market funds, for example, and interest rates are 5%, and I put in maybe 100,000 at 5%, I know how much I'm going to get. If in 2 months' time rates move up to 10, and I put in maybe 1 million because I got a bonus, then the effect of the 1 million compared to my 100 will give me better returns at 10%. I don't know if you're understanding what I'm saying so far. Let me see. No one is saying anything. Okay, so that's basically what the returns are. So we have different calculations. Like I said, if you're going to do quants, you need your calculator handy. And okay, so I see yeses. So everyone is on the same page so far. So when I hit the portions where the people who were 5 need help getting to a 10, please let me know. So let me speed through this because basically if you know how to cram formulas and you have a calculator, I think you should be fine with this. Okay, so trimmed mean is when you have some outliers. Outliers are if I have 1, 2, 3, 1, 2, 3, 1, 2, 3 on the average as my range, and then I have a 17, for example, compare 1, 2, 3 to 17. You call 17 an outlier, means it doesn't fall within the regular band of the data set. So a trimmed mean will be to eliminate the outliers so that you can have an accurate value of what it is you're like I said, I would run through all of this part so that we can move fast. I've spoken to analyze returns means if you're getting your returns on a daily basis, you want to say what will it translate to at the end of the year. So most times when you meet anyone who is in investment, they will tell you analyze returns at 10%. Someone feels if he puts 100 naira today, in a month, he's going to get 10% of 100 naira. When they say annualized, it means if you keep 100 naira for a year, you will get 10%. So when you see 20% annualized, you will need to discount by the period you want to hold it in. And so that's what that first equation, which I titled it, speaks to. We will run through examples eventually. So a continuously compounded return means if I put in 100 naira and like for money market funds, they generate returns at the end of the month. So in a month, maybe I get 2%. You're adding the 2% to my 100 naira. And then in the next month, I'm going to be at 102 plus another 2%. So you're reinvesting the income you're getting, basically, is what we're speaking to here. Okay, so I'd like us to go through some questions. So we're going to do it like this. If your name starts, your name or your nickname or whatever, if your name starts A to, let's say J, please try to do number 2 and 3, and then the rest of the people on the call, please try to do 5 and 6, so that I will see 2 is a C or 3 is a B, and then 5 is a B and 6 is an A. Can I see that, please, so that we can move on? Okay, so 2C, 5B, 2C, 2B, 5B. Okay, so let's see where we are. So ignore number 1, it wasn't there, but just, for completeness, a nominal risk-free rate incorporates an inflation premium. So 2 was C, correct. Abdul Salam said B. Let me see what B was. Okay, so Abdul Salam, let me speak with you because you said 2 is B. So which of the following risk premiums is most relevant in explaining the difference in yield? So focus on this: 30-year bonds, treasury bills, and 30-year bonds by a corporate issuer. So Abdul Salam, I'm speaking to you because you said 2 was B. The 30-year bond, treasury bill, 30-year bond by a corporate issuer, the maturity is the same. So maturity will not be the answer. It will be liquidity. Blessing got that right. Chisom got that right. So it will be liquidity because the corporate issuer is a small investor. So if you hold shares in my company, for example, I mean, I'm not globally known. I'm not a big corporate with a very large balance sheet. So chances of you offloading those shares would be pretty difficult. That's where the liquidity comes in. So I hope Abdul Salam got that right. So the difference between a government issued bond, you can trade it on the primary market, you can trade it on the secondary market. For an Oluwatoyin and Sons Limited, it's almost difficult to offload when you want to, if you want to do that before time. So 3 was geometric mean. Let me see. Did anybody answer number 3? You guys are dodging number 3. Nobody answered number 3. So have to remember that time is an important aspect of the exam, and so nobody answered number 3. Okay, so let's just walk through. So there's a formula for geometric mean. I don't think I'll need to dwell on that. If you know what the formula is and you don't make any mistakes on the exam, you shouldn't have any issues. Which of the following statements regarding the geometric and arithmetic means are correct? Okay, so option 1 is the mean will exceed the arithmetic mean with a series with non-zero variance. I'm not sure what that means. Geometric mean measures an investment compound rate of growth over multiple periods, or the arithmetic mean measures an investment's terminal value. No. So arithmetic mean doesn't have anything to do with terminal value. So B is the correct answer. Most people got that right. Thank you very much for that. Number 6 is a calculation. A fund receives investments at the beginning of each year and generates returns for 3 years as follows. Which return measure over the 3-year period will be negative? Okay, so if we look at 1, 2, and 3, we see that in year 3 there's a negative return. So you lose money at that point. And so the money weight, like I had described before, is dependent on how much you put in and when you put in your cash. So if you have 1,000 and you had a 4,000, and then in year 3, when you're going to lose a lot of money, you bring in a 45,000 USD, it will affect your returns. So for 6 will be C. Let me see. 6C, 6C. Okay, so we're good. So that means so far on the rates and returns, I would say we're doing a 10 over 10. Thank you very much, guys. So let's move on to time value of money. Okay, 3A, let me see. Yeah, 3A, okay, thanks. So let's move on to time value of money for fixed income and for equity. So when we say fixed income, we mean bonds. Sometimes they're semi-annual, most times they're semi-annual coupons. So it means you would, how do I describe a bond? So it's someone borrowing money, a corporate or the government borrowing money. So if I approach, let me see, whose name do I see? Samson. Okay. So if I speak to Samson and say, Samson, please lend me 100,000, I would give you 5% semi-annually, and I'll pay you back in 3 years. Something is indirectly giving me a bond. So upfront, he could be trading, the bond could be trading at a premium or at a discount. Now the full value, the face value of that bond in 3 years would be 100K. I'm going to give Samson 100K in 3 years. Today, how much I collect from Samson? I could either take maybe 97,000 or 98,000 from Samson now. Means the bond is trading at a discount, or take 102, depending on the health of my company, means it's trading at a premium. And then I will regularly pay Samson coupons up till the point of maturity. At maturity, I return the final coupon payment and the face value of the bond, which is 100,000. So that's basically what it is, the generic form of a bond in a nutshell. So we have different kinds of bonds. There's a zero coupon bond. You buy it for less than the face value, and then you receive full value at maturity, so there are no payments in between. A fixed coupon bond was what I described just now. And then we have perpetual bonds, which means I'll continue owing you perpetuity. So if I move to annuities, it's a regular payment that is going to be made. Think mortgages for people who have houses outside the country. You borrow money, or if you maybe borrow money to buy a car in Nigeria, you borrow money and you're going to make regular payments up till the point where you pay down on the loan. So that's what an annuity is. Like I had said before, the calculator is your best friend when it comes to quant. And so I would expect that everybody is comfortable with those things described on the left-hand side, present value, future value. Can I get a thumbs up if that's the case? Thank you very much, Toby. Okay. Thanks, Tori. Okay, so there's a formula for calculating a future value, and there's a formula for calculating present value. You can want to know the formula, or you can just know how to calculate it on your calculator. Either is fine. So let me just talk through. So the future value of 100 naira in 3 years is, I'm going to compound the 3%. How much my interest rate? Let me say 5% interest rate. I'm going to compound 5% in 3 years and then multiply by my 100 naira now. So if you wanted to find out what the present value is, you would just make present value the formula, the subject of the formula. That goes without saying. So we have different kinds of stocks. We have common stocks, we have preferred stocks. There's a formula on the right-hand side, the Gordon growth model, which is something you would see feature in different parts of the curriculum. The present value of equity is equal to the current value of dividends paid times 1 plus G. So that means you're checking how much dividend is going to be paid in the next period, and you divide that by required return over growth. This is a formula you should know in your sleep. Like I said, it shows up in different parts of the curriculum. And then there's a multi-stage discounted model where the growth rate changes drastically from one period to another. Once you know the formula, you should be fine. Okay, so if I speak to interest rates, a forward rate is how much you're going to pay at some point in the future. Spot is what you pay now, which is what you also see when we're discussing the derivatives. So you know that the curriculum is linked. So I think some of these things should not be a problem for you right now. So let's go to practice questions. So we have 1, 2, 3, 4, 5. We have 6 questions here. So let's say if your name is A to J, you answer 1 and 2. So I to maybe S, do 3 and 7, and then T to Z, please give me 11 to 12. Can I see what your answers will be quickly? Someone is asking, do we need to memorize all those formula? You would have to, as much as possible. Okay, so I'm waiting for you to come back to me or the answers, please. If you're working on it, can I get a thumbs up? Let me know that I start talking through the answers myself. Okay, so Toby says yes, so I'll wait a bit. Okay, thank you guys. I'll wait for your responses. Yosef, you said C. C, what number, please? I need to know what number you're speaking to. Daniel said C. Please give me the number and the corresponding alphabet so that we can track your responses. 1A, 1C, 3B. Okay. No one has attempted 11 yet. 3B. Okay, so let's talk through. So this these people issued a 10-year corporate bond 2 years ago. And so that means we're currently in year 8 if you're using your calculator. The bond pays annual coupon of 10.7 on a semi-annual basis. So that means that at the end of the year, you get 10.7. So if you want to break it down, it means every 6 months, you get 10.7 divided by 2. We need to keep those things in mind. The current annualized yield to maturity is 11.6. Like I said, because they're paying coupons on a semi-annual basis, is either by multiplying by 2 or dividing by 2. So the period is multiplied by 2, the returns are divided by 2. Means annualized, you're going to get 11.6 at the end of the period. So per 6 months, we'll say 11.6 divided by 2. I hope I'm speaking English that's clear. Okay, so how much is the current price of the bond? You can choose to work it out like if you have the energy, but if you want to be fast so that you can have time to answer other questions on exam day, I will suggest pulling out your calculators at this point. And so let me okay, so every time you pull up your calculator, the first thing you have to do is clear your memory so that it does the calculation you had in before, it's not distort your. So because I have a calculation here, let me just clear my memory. You always have to clear your memory. Okay. So the bond was issued, is a 10-year corporate bond. We're 2 years into the bond, so we're at year 8. So the period left is going to be 8 times 2, which is 16. I hope you're on your calculators as I am. So N is 16. Annual coupon is 10.7. I'm dividing that by 2. That is my 1 over Y. No, that's coupon. So that's my payment. And so the yield to maturity is 11.6. 11.6. I'm divided by 2. That's 1 over Y. And so what's the current value? I need to do this again. So the current value is C, 95.3. Toby got an A. I'm not sure why you got an A, Toby, but the answer is C. Would you check your calculation again? Okay, so on to number 2. Someone wants this real estate seeks a fully amortized fixed rate 5-year mortgage loan to finance 75% of the purchase. So if I was in the exam, the first thing I'll do is what's 75% of 5 million? That's 3.75. So I'll have 3.75 handy. That's how much we're discussing here. Because on the exam, you probably see a value for 5 million. So you need to be careful when you're solving, right? You have to get your details right. So I'm working with 3.75 million. They want to purchase a residential building that costs this. The annual mortgage is this. The monthly payments will be closest to what? So what they're saying is, I'm going to borrow 3.75 million US New Zealand dollars today. My annual rate is 4.8. They're asking what my monthly payment will be. So you have to be careful that when they say monthly payment, it means I'm going to divide my mortgage rate by 12 and multiply my 5-year period by 12. So I'm not dealing with 5 years, I'm dealing with 60 months. Can I just see if everyone is on the same page with me? Okay, so I have a 2A. All right, so that's what it is, basically. That's what you need to know. So N is 5 times 12. Annual mortgage rate is 4.8 divided by 12. Your present value is 3.75 million or 375,000. And then you compute payment. That would give you 70.4. 2A. Okay, thank you. So 3, this corporation pays an annual dividend to its shareholders, and its most recent payment was 2.4. They expect the dividend to grow at a constant rate of 3%. So we're not dealing with a multiple DDM, we're dealing with a single one, okay? I expect it to grow at 3% in perpetuity. The shareholders require a return of 8%. Expected share price is closest to what? Let me show you that formula again. That's this one here. The R is equal to current dividend payout times 1 plus the growth rate divided by R minus G. Where's that formula? Okay, yeah, that's this one here. Okay, so that's the formula for that. And if you solve that, your answer will be 49.44. Okay, so let's move on. What would it mean if we asked in yearly, what would it, so I'm trying to read the question. What would that mean if we asked in yearly payments, we just use number of years given? Yes, so if you were asked for, if everything was annualized, then you will obviously be using the figures as they are absolutes. The only time you would have to convert is if you're discussing monthly payments or semi-annual payments or quarterly payments. You would, if it's quarterly payments, for example, now you're giving an annualized rate of return, you will have to divide the rate of return by 4. If you were if your period was in years, maybe 5 years, for example, you have to say 5 times 4 to give you the number of periods in quarters. So, but if it's annualized, then you please, by all means, stick to what it's supposed to be. I hope that answers your question. Okay, someone asked, why are they growing in number 3? Okay, so let me go back to the formula. I hope you can see the Gordon growth. The person who asked, Daniel, you asked why is it growing? Look at the formula. Like I said, this is a formula you should know by now if you're writing an exam in a week or two, because this formula shows up in multiple parts of the curriculum. The formula is the present value of a share. The share price today is the dividend paid out today or paid out most recently incrementally. That's you compound by growth rate and then you divide by the required return minus G. You need to know this formula. You need to be able to solve for R, you need to be able to solve for G. That's the reason why we're compounding by 1 plus G. I hope that answers your question. Okay. All right. So I will say we're done with time value of money. These are the solutions. Let's go to statistical measures of asset returns. Okay. All right. So arithmetic mean is what we do normal. That's it's done in primary school. 2 plus 3 plus 4 divided by 3. 1, 2, 3, 4, 5 divided by 5. 1 plus 2 plus 3 plus 4 plus 5 divided by that's basic. Median and mode, I don't think I need to go into that either. Let's discuss measures of location. So a quartile, quart 4, queen 5, deci 10, percentile is 100. So we should be familiar with those by now. So a quartile means you're going to share the distribution into 4 equal halves. Anyone that is a firstborn here should be good at sharing stuff. So if I say quint, I'm dividing it into 5. So if, for example, I had 100 units or something, and I say, what's a quartile range? It means you're going to say 100 divided by 4. So I'll have 25, 50, 75, and 100. Right? If I said it was quintile, that's divided into 5 places. Still working with 100, I'll have 20, 40, 60, 80, and 100. Decile is in tens, so I have 10, 20, 30, 40, 50, 60. And percentiles is 1, 2, 3, 4, 5, 6, up to 100. So an interquartile range, like I said, quartile is divided into 4 parts, is Q3, that's the 75th portion minus the 25th portion. Okay. Range I would ignore. Mean absolute value is, so now we're discussing deviations from the mean, but in this case, we don't care what the sign is. So we're going to take the absolute value. So if it is a -3, a +2, and a -1, we'll just say 3 plus 2 plus 1. We don't care what the negative sign there is in front of it. And then we divide by the number of, divide by n. Variance is another formula that you should be conversant with. It's also something you can get on your calculator. So coefficient of variation is standard deviation of x over the average value of x. Let's see. Okay, so let's talk about skewness. It means the distribution is not symmetrical, means it's either tilting to the left or tilting to the right. I have spoken about outliers before. If your range of values is from 100 to 200 and you suddenly have a 1000, that 1000 is an outlier and it will affect the mean if you were working on them, if you're trying to calculate the mean. Okay, so for this, let me move on to graphical because I think if we speak graphical, it might stick. I'll come back to the previous slide. So like I said, skewness is when the thing is bending to one left or right. So how do we know which one is positive skewness and which one is negative skewness? Imagine if you're, as I'm sitting now, you're probably also sitting down. The right-hand side, we always assume is the good thing. They say when you're giving something to an elder, you don't give something with a left. So we'll assume that everything right-handed is positive and anything left-handed is negative. Doesn't mean it is, but just for illustration's sake. So in this case, if I say positive skewness means that the tail is on the right. Just remember in the exam, what did she say? I'm supposed to be respectful. I give elders things with my right, and that's the positive skewness. That's where the tail is. Negative skewness, left-handed. The tail is on the left. Now, no disrespect to people who are lefties. And now, how do we know where the mode, median, and mean are? Because the question could be, is the mode greater than the mean, or is the mean greater than the mode? That could be a question you will be asked. And so, if you can see the box on the right, bottom right, I said the mean is always in the middle. So if you're comparing property A and B, you see that the mean is right smack in the middle. And then, so is the mode that is either shifting to the left or shifting to the right? Because like I said, the distribution is either tilting to the left or to the right. So always remember that the mean is central. It doesn't change. That's how good the mean is or how strong the mean is. The median compared to, in relation to the median and the mode is always in the middle. Makes sense, right? I'm just reminding myself that I need to speak a bit slowly. Okay, so the median by default or by definition means it's in the middle. So it will always be between the mode and the median. It will always be between the mode and the mean, excuse me. The issue is where the mode lies. So if you've in your head remember that positive skewness means the tail is on the right, it means most of the distribution is tilting to the left. It means mode will be on the left hand side. If it's negative skewness, like I said, the left is where the tail is, means most of the distribution is tilting to the right, so the mode will be on the right. So if I had asked the mode, if the mode is less than the median is less than the mean, is it positive skewness or negative skewness? If you think through, you don't need to cram it, you should know that it's positive skewness. And so I'll speak to exhibit 18, top right. Okay, thank you, Hafsat, for that. Okay, so if you speak to exhibit 18, is it fat or is it slim? Okay, so if you've ever been on a diet, you will not forget this either. So a fat tail, if you look at exhibit 19, is usually higher than, means you have eaten and you're well fed, and so you're usually higher than the normal distribution. If you're thin-tailed, it means you've been fasting or you've been starving yourself for whatever reason you want to fit into that dress, or if you're getting married or you have a party, you want to fit into that dress, and therefore you're going to be lower than normal, means you're slimmer. I hope you would remember that. So someone who has chop belly full will rise above the normal distribution. And if you've not been eating, you will be below the normal distribution. So that's what the thin-tailed and fat-tailed represent. The English is there for you to remember. Another way to remember is that's one way to remember. Hopefully that will stick. So let's go back to what's in the text. This was just to help you remember. Okay, I didn't talk about kurtosis. Yeah, I did. Okay, so that's that on the left-hand side, bottom left. And so on excess, there's a figure for that. If it's above 0, you'll say it's excess kurtosis. If it is equal to 0, then we are the normal distribution. If it is less than that, it is okay. So let's see. A scatter plot is just imagine you give your 2-year-old a biro and say, do the best will just be doing dot 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 all over the place. That's what the scatter plot looks like. There's no, you can't see any recognizable pattern. Covariance is how two people move together. Can two agree? Can two walk together except they agree? Is what covariance is. So is there a way for us to track how well one variable is doing with respect to the other? Imagine seasons and maybe selling ice cream. I know that people tend to buy ice cream more in traffic when the weather is hot. And if it's raining, the people won't even be there on the streets to hawk anyways, so you won't tend to buy ice cream. So is there a correlation between weather and sales of ice cream? Something like that. Is there a correlation between rainy season and flooding? People going to the mechanic. I'm sorry, let me behave myself. Okay, so correlation coefficient is you trying to standardize that covariance. So like I said, I've spoken about flooding and going to the mechanic. I've spoken about buying ice cream and rainy season. But so they could be varied. I mean, I could be discussing hundreds of thousands on one side, and I could be discussing decimals on another side. If we're discussing returns in USD are usually like 5 to 6%. Compare that to maybe how much Guinness sells in a month. I mean, the rates are astronomical because football is coming on, so people tend to. Okay, back to what we're discussing. So correlation would help you like standardize the covariance. So you would always divide covariance by the standard deviation of X and Y, which are the two variables you're trying to see if they relate. You will need to know this. If you don't know anything else, please remember that correlation standardizes covariance. They're related in some way. The only difference is you're trying to keep one in the units that you can use to compare to something else. So because you're dividing by standard deviation of the two variables, correlation ranges from -1 to 1. It doesn't have any units. If two variables have a correlation of 1, it means they have a perfect relationship. Imagine twins who probably eat the same thing, say the same thing, something like that. A correlation of -1 means as you're moving left, I'm going right. We have a perfect relationship, but we're moving in polar opposite directions. A correlation of 0 means if you're here, I could be roaming around wherever I choose to. Just imagine you throwing a plastic at the beach, and the plastic can go whichever way. Meanwhile, you that threw it into the water, you're stationary. Assuming water doesn't carry you, but you're stationary. But that plastic you throw, don't throw plastics into the ocean though. But that's just for illustration purposes. So if you do that, it will be roaming around and it could, get to Canada before you. So that would be, an example of no correlation. A spurious correlation means chance is the reason why you think there's a relationship. We'll come to that. Okay. I'm not coming to that. It has ended. Okay. So let's look at these practice questions. There are only 2, so everybody attempt all. I'll give you a minute. It's too tiny. Oh. Okay, since it's tiny, let me just go ahead with the answers. Okay, so 2 variables A and B. A has a mean of -0.5, B has a mean of 0.2. The covariance is positive. The correlation between these 2 variables, is it positive or negative? Is positive. Remember, I said that the correlation standardizes the covariance, and the covariance is positive. So it doesn't matter what the mean is. It's, look at the formula again. Can you see the formula? Oh, the formula is not here. Anyways, so it's so it's here on the right hand side. Covariance is a measure of how two variables move together. The correlation coefficient not only shows the linear relationship, but it also shows the strength of relationship. Is covariance standardized by dividing by the product of the standard deviation? So the mean is part of what you use to calculate standard deviation. Standard deviation is x minus x bar squared. So even if your mean is negative, when you say x minus x bar and you square it, it doesn't matter what was in the bracket, it will always turn to positive. So you need to know that standard deviation will be, so you need to know that the covariance is what's critical. And in this case, the covariance is positive. So the correlation between those 2 variables is positive. I need to, oh, it was hidden in the question. Okay, so you need to learn to, Hafsat said the covariance was hidden. You need to read the question well. If you answer what you think they asked you. Okay. Second question, without calculating the correlation coefficient, the correlation of the portfolio returns and the bond index returns is most likely to be. Did anybody answer that? The scoring says it all. Thank you, Ola. Okay, so 2. Did they say 2A? Why did they say 2A? No. It's C. It's positive. The covariance is positive. I just said that. The correlation coefficient standardizes the covariance. So if the covariance is positive, they definitely are moving in the same direction. Why is number 3 C? That's what I just explained. Without calculating the correlation coefficient, arithmetic average is this, portfolio returns is that, the index is this, the standard deviation is that, the covariance is 18.9. Daniel, can you see the covariance is 18.9? Can I get a thumbs up from you, Daniel? Covariance is 18.9 in number 2. Therefore, it's positive. So whichever way you dice it, your answer is going to be positive. So I think I need to move a bit faster. Let's discuss probability trees because I want us to try and cover everything before 1. Okay, so probability. Is anybody having issues with probability? You're welcome, Daniel. Anyone having issues with probability? Can I get a thumbs up or no? Yes. Okay. So probability, what was the probability that you were going to respond? Yes. Okay. Okay. So we'll spend some time here. So probability is chance, basically. If you roll a die, what's the probability that you're going to get 1 or that you're going to get 2? So the probability is how many numbers are on a die? You have 1, 2, 3, 4, 5, 6. Probability that you're going to get 1 is 1/6. The total number of outcomes is, it can either be a 1 or a 2 or a 3 or a 4 or a 5 or a 6. What's the probability that I'm going to roll a 2 is 1/6 still. If you toss a coin, it's either heads or tail. What's the probability that you're going to get heads or you're going to get tail? So that's basically what it is. If you ask your dad for money, what's the probability that he's going to say yes or no? It depends. Were you a spendthrift before? Have you shown that if he gives you money, you will use it wisely? You will increase your probability of getting money from your dad. So that's what probability is, basically. If you have allergies, maybe you have allergies, you're allergic to nuts. What's probability that you're going to knowingly eat nuts? Almost 0. Means I'm not going to go near it. That's what probability is. So it's chance, basically. And so the probability for an event ranges from 0 to 1. 0 means no way, I'm not going near it, which is the case of you being allergic to nuts and knowingly eating nuts. Or a 1, someone you care about says, give me a hug. You most likely to give the person a hug. That's the probability of 1. So mutually exclusive means they can't occur at the same time. It can't rain and not rain at the same time, right? I can wear blue and white, maybe a blue top and white jeans, but I can't be in Lagos and in Abuja at the same time. So that's what mutually exclusive means. It means it will help you get the whole range of possibilities that an outcome can be. So there's some formulas you should know. Let's see. We'll come back to this. Okay. So I will slow down here a bit because I've gotten a lot of yeses on probabilities. Yes, we'll talk about Bayes' theorem. So unconditional probability is probability of A happening irrespective of the outcome of other events. So you're going to write this exam. It doesn't matter how you feel, you would write this exam, I guess, right? So that's unconditional probability. You've paid for it, it's happening here, you can't defer anymore, so you write the exam. So that's unconditional probability. It's not dependent on how you feel. Conditional probability means something happens, then I decide what to do. So if you drive, for example, and you're halfway to where you're going, and you check Google Maps, and it says that the route you're currently on, especially for the Goshen's, is all red, you will decide, do I want to stay in traffic, knowing what I know, or do I want to pivot to a different route? That's conditional probability. You know something, and then you decide, where do I go from here? That's conditional probability. Okay, so there's some nice formulas we'll speak through just so that it's easy. Joint probability is probability of 2 events happening at the same time. So let's go all the way down to the Bayes formula, which is an issue. Let's look at an example on the right-hand side. I would want to talk through the example slowly and hope that will quench this Bayes theorem once and for all. So the formula is there for any event A and B. I included a footnote at the bottom. So let's start with that. What you can see that is background in white. So probability of a new information divided by the unconditional probability of the information times, don't get cross-eyed. Let's come back up to base rule. So probability of A happening given B is what you see on the left-hand side. I'll take that again. A is the event, B is the information. So what will you do with A given that you know B? In this case, A is I'm going somewhere. B is Google Maps says there's traffic on this route. What do I do given B? I hope that's clear. Can I see that definition stuck? Because if you get that right, then everything else is just a formula. No. Okay. Yes. Any yes or no? Almost. Okay, so let me take it again. B is what you already know. You're going from B to A, basically, is what base formula says. Like I said, you're going from point A, you're going from Lagos to Ibadan. No, let me go to Canada, please. You're going, okay, let me go to Ibadan. You're going from Lagos to Ibadan, and you find out that there's traffic on the road. Maybe somebody's coming into town, and so they block everywhere. What do? Do you defer your trip, or do you enter road and stay there till tomorrow? So it means B is somebody's in town and they've cornered off all access into Lagos. A is, do I progress in my journey or not? Is that definition clear? Yes. Yes. Okay. Thank you very much. Okay, so that's basically what we're saying. So you see, once you get that, you're good. You can now come back to the formula and find and replace, really. You just need to understand that B is the information, A is what you do with the information, basically. So the formula is standard. You just need to know what the formula is and then find out how to work. So let's look at an example. Probability of an increase in interest rates is 70%. So as I'm saying it, please be writing. Look at the solution. Probability of I interest rate is equal to 70%. Everybody, please write it. Probability of interest rate increase is 70%. It means the probability that interest rates will not increase is 30% because probability sums up to 1. I think I didn't say that before. Probability always sums up to 1. So when I said mutually exclusive, if you add everything that can happen, it should always sum up to 1. So that first line, are we good? Probability of an increase in interest rate is 70%. Probability of the interest rate not increasing is 30%. Yes, thank you. Okay, so we move on. If interest rates increase, the probability that the economy grows is 30%. Stop there. I take it again. If interest rates increase, the probability that the economy grows is 30%. So, guys, can you tell me what has happened? Okay, for time, I would answer. Rates have increased. So, economy grows 30%. Look at the next line. I is rates have increased, like I told you, going to checking Google Maps. Therefore, the economy grows by 30%. You see that base theorem is not so bad, right? That's 30%. If rates increase, that's giving I that rates increase, the probability that the economy grows, which is G, is 30%. That's that one. While if interest rates don't increase, that's what IC represents here. The probability that the economy grows is 60%. So if rates increase, probability is 30%. If they don't increase, probability is 60%. Question, what's the unconditional probability that the economy will grow? So I don't know how to do this. Let me see. So the probability that the economy is going to grow is equal to the probability that it grows, whether rates increase or whether rates don't increase, basically. That's what that next line says. So the probability, the economy is growing, whether rates increase or don't is the question. And so it's equal to, you just, how do I say this? Okay, so imagine if, imagine if you're supposed to give money to someone, for example, and there's someone who you know probably earns better than you, but you've committed that the first person or the first two people I see, I'm going to share money to them, and you have maybe 100 naira in your pocket. And you say the first two people I see, I'm going to share this 100 naira between two of them. And the first person that comes is someone who has more money than you. You probably just want to give the person 10 naira just to fulfill righteousness and keep 19 naira for someone who desperately needs it, right? So that's what weighting is, 10% and 90. I don't know if you're still on track. Someone says he uses the tree. Okay, so it means we're making progress. Okay, so what we're saying now is the probability that the economy grows is the probability that it grows whether the rate increases or not. And so if you key in that formula, you can see probability that given that interest rates increase, the economy grows is 0.3. We have said that before. Probability that interest rates increase is 0.7. Add that to the probability that interest rates don't increase is 0.3 times this. And so when you solve that, you get 3.9. We have some questions that might help. Okay, someone says yes. Okay, so we're solving. They're just two. I'm halfway through my time. I need to see. Can we go through this, please? Okay, makes sense. Okay, so should I wait for you or I should go ahead to display the answer? Wait, okay. No answer has come in yet. But I'm on pause. B, George, is B for number one or number two? I need to know. B, number one. Okay. Two A. Okay. Anybody else? Okay, so let's move on. You can continue calculating while we go through. So 1B, 2A. George, I'm clapping for you at this point. Well done. So is my work done? Do I need to talk through or I can move on to the next topic? George is making me proud. See the question, okay? You estimate that 20% of high-risk bonds will fail. If you apply a bankruptcy prediction model, you find that 70% of the bonds will receive a good rating. Okay. Ola, are you good? Okay. So let's just see. Same thing I said before. Probability that giving B, A happens is the question. And so if you read through the question properly, you will see that there's a probability of failure of 0.2 and a probability of a good rating of 0.7. And then the probability of a good rating given failure is 0.5. You plug it into the formula, you're fine. You just need to understand the concept. Probability of what are they speaking to at this point? And then number two has to do with expected sales and variance. Let's move on to portfolio mathematics. Is this a place to spend time on, or do we breeze through? No response. Okay, so portfolio mathematics, breeze through. Okay, does anybody else say to breeze through, or should we spend time here? So we focus on the areas where you actually need my help. Breeze through. Oh, nice. Okay, so good. So no need to spend time on this. Breeze through. Ah, fantastic. Okay, so let's just move on then. So let's go straight to the questions. The breeze through gang, please. Breeze through gang, please. Oh, I already given you answer. Breeze through gang. Should we do this or we should move? We should move on. Okay, so let's move on. Someone is mentioning linear regression. Okay. Simulation methods. Breeze through. Spend time. Breeze through. Okay. Anybody else? Do we discuss simulation methods or do we move on? Spend time. Let's discuss. Okay. Okay, so let's pause at this point. So I have, before we come back to what's in the material, I think I don't. Thought I had something for now. Okay, so maybe it was, okay, yeah, so look at the bottom right-hand side. Remember your days from, what's it, primary or secondary school, where you used to say base 10, base 8, base 2. So that's what we're discussing here. Bottom right hand, that small box there. So log 10 is anything to base 10. So log 100, for example, once you're discussing to base 10, you ignore the 10. It's given that it's base 10. It's when it's another number that you need to put that subscript of 2 or 3 or 4. So log 100 in base 10 is equal to 2. It implies that 10 raised to power 2 is equal to 100. That's basically what it is. So when we talk about log normal, we're discussing base E. E is a constant, it's equal to 2.7183. So it's the same thing, really. Just replace 10 with E. And so instead of saying log something to base E, we change it to ln, log normal. That's basically what it is. So if log 100 in base 10 is equal to 2, which implies that 10 times 10 is equal to 100, log normal 100 to base E, we don't include the E, is equal to 4.6, implies that E raised to power 4.6 is equal to 100. It's that simple. Are we good so far? That's basically what we're saying. So we use log normals for probability distributions, for option pricing models. I'm sure you'll meet that somewhere else in the curriculum. Natural log of y is normally distributed. It follows that y is a log normal distribution and vice versa. So it's bounded by 0 and is skewed to the right. It has a long tail. Log normal distribution ensures that prices are always positive and it captures extreme events. We already know what continuous compounding is. We know what volatility is from somewhere else in the curriculum. Monte Carlo simulation is just using a software. And so, do you have any questions here? Because we're moving on to practice questions. You guys have gone quiet on me. Am I speaking to myself at this point? Okay, someone says explain bootstrapping. So bootstrapping is you have a whole population of everybody in Nigeria, for example, and they say do random sampling. Now I can't meet everybody in Nigeria, that's almost impossible. So I would reduce it to a sample size. That's what sampling is, random sampling. And so bootstrapping says you keep drawing from the same subset you already have. So if example is those people who do who follow people over time. Like they say, what were you doing when you were 10? What were you guys eating? Which schools did you go? I want to see what the effect is in 5 years' time. You use the same set of people, those test subjects in 5 years, and then in 10 years, you want to see whether the school you went to affected your outcome. Those, I don't know if any of you know those studies. So you're using the same kind of people, as in you're drawing from the same sample over time. That's what bootstrapping is basically. Okay, so let's look at some practice questions. Continuously compounded returns. Contrast normal distribution to a log normal distribution. The log normal distribution number 3 is an accurate model for the distribution of stock prices. Is a more accurate model for the distribution of stock prices than the normal distribution because stock prices are asymmetrical, unbounded, or negative. And so, would you attempt quickly before we check what the answers are? Three C, 2B, 2B, 3C correct. 4A, 4A correct. 2B correct. Okay. Number 1, nobody has attempted number 1. 2, 3, and 4 are correct. What of 1, 5, and 6? 1A correct. So 5 and 6. Can I get answers to 5 and 6, please? We're done with 1 to 4, 5 and 6. Okay. So 5 is C. A Monte Carlo simulation can be used to A, directly provide precise valuations of call options. No, it can't give you any precision because it's a simulation. B, simulate a process from historical records of returns. Or C, test the sensitivity of a model to changes in assumptions, for example, on distributions of key variables. Yes, that's the correct answer, C. 6, a limitation of the Monte Carlo simulation is it fails to do what if analysis. No, it requires historical records. No, its inability to independently specify cause and effect relationships. Yes. Let's see why. So I'm not focusing on 1 to 4 because most of you already answered that correctly. So let's focus on 5 and 6. So Monte Carlo is a characteristic feature is the generation of a large number of random samples from a specified probability distribution. It's useful for investigating the sensitivity of a model to changes in assumptions. That was C. A limitation is a complement to analysis. It's a complement to analytical methods. It provides estimates and not exact values. I had said that before. Analytical methods, when available, provide more insight into cause and effect. Let me go back up so that we see. So a limitation of Monte Carlo simulation is its inability to independently specify cause and effect. An analytical method would do a better job of that. By moving on to estimation and inference, pause, breathe through. Do we pause or we breathe through? Looks like we're doing well for time. Pause. Okay. Okay. So probability sampling, we've spoken about that before. There's an equal chance of being selected. So it means if someone gives you a bag full of balls, red balls, yellow balls, blue balls, and blindfolds you and says, pick a blue ball, you could either pick the blue, the red, or the what's the called? I can't remember. So there's an equal chance of each ball being selected. That's probability sampling. No probability sampling, it depends on other considerations. For example, the judgment call or how accessible you are. Some people like the color blue, for example. So you say, I want to see more blues in the bag before I pick. So that's a non-probability sampling. It means you're increasing the chances of you picking a blue ball. So that's the difference between probability and non-probability sampling, basically. Simple random sampling, speaks to the probability sampling. Every item has an equal chance of being picked. A systematic sampling is you pick every fifth, for example, or every sixth, for example, or every seventh item until you get total. Imagine when you're walking through immigration, someone just doesn't like your beard and he pulls you aside. Or they say every sixth person will pull aside. So that could be a systematic way of sampling. You don't just randomly say, when I open my eye, the person I see is the person I pick. It could be a tall, short, fat, black, white person. You just say, for every seventh person that comes off this plane, I'm going to pull you aside. That's systematic sampling. Stratified means you first of all divide the population into subpopulations, and then you randomly draw samples from each size. For example, you can say people who were born between 1980 and 1990, I'll pick 10 people from there. People born between 1991 and 2000, I'll pick another 10 people from there. Between 2001 and 2010, another 10 people. So you're sure that within each decade, you're going to pick 10 people. So it's still random within those decades, but if you had opened it up, there's a possibility that you have picked more people in maybe the 1980 to 1990 bracket than maybe the 2000 to 2000. So that's what stratified random sampling is. You break them up into specific segments and then you pull. So cluster sampling is something similar. You divide population into subpopulations and then randomly draw certain clusters to form the sampling. So reason for non-probability sampling is convenience. You might not be able to speak to all the homeless people in Lagos. So if you see only the people in your area, you will say, let me work with those people and assume that they represent the whole population. It could also be a judgment call. You feel the people in a certain part of town might be more suited to what it is you're asking than going around the whole of where you stay. So central limit theory means that randomly distributed variables are identical. They have finite variances. It's normally distributed irrespective of the variable. In simple terms, it means the more you increase your samples, irrespective of what you're checking, whether you're looking at how many cars pass Lagos Ibadan Expressway, or you're checking how many times children scream when they are given injections. If you increase the sample size long enough, if continues to increase, eventually everything tends to be normal. The mean and the variance tend to be normal. That's what they're saying. It doesn't matter what it is you're doing. If you say, how many times do I change my hair in a week? If you check how long you've done that in over 10 years, weekly for 10 years, you see that it also tends to have a normal distribution. That's what the central limit theory is. So we have questions to walk through. I hope you won't say, is this also very tiny? Do I need to read it? We have 1, 2, 3, 4 questions. Is anybody making an attempt, or do we go ahead? Okay, so let's move on because I think there's some weightier issues up ahead that we'll need to review. Let me read through. An analyst is studying R&D sent by a pharmaceutical company. She's considering 3 sampling methods for understanding R&D. Method 1 is to use all the data available to her from an internal database that she and her colleague built while researching several dozen stocks. So let me stop there. Question 1. Method 1 is an example of, let me read question 1 again. Is to use all the data available to her from an internal database. So it's convenience sampling. It's internal database that she and her colleague built. So it's convenience. She didn't say she wanted to go to find out from all the R&D companies global what's going on. She just focused on the one that was within reach. So that's convenience. Let's move on. Method 2 involves relying on a commercial database provided by a data vendor. She will select every 5th pharmaceutical company on her list to pull the data. So that's systemic, like I said, systematic, like I said. You pick every 5th or 6th or 10th or 100th. Method 3 is to divide pharmaceutical companies in the commercial database into 3 groups, according to the region where a company is headquartered, and then randomly select a subsample of companies from each group, with the sample size proportional to the size of its associated group in order to form a complete sampling. That's stratified. I read that again. She will divide the pharmaceutical companies into 3 groups according to the region where a company is headquartered, and then randomly select a subsample of companies from each group with the same sample size proportional to the sizes of its associated group in order to form a complete sample. That's stratified because the population is divided into 3 stratas by region, and then random sampling occurs. So number 4, a seasoned auditor is auditing last year's transactions. Unfortunately, this company has a very large number of transactions and the individual is under a time constraint to finish the audit. He decides to audit only the small subset of transactions. What would that be? It's a judgment call. He's using his knowledge to make a judgment as a seasoned auditor. So I'll move on from this. Oh, we have another set of questions. Let's move on. Thank you. Okay, so let's go to hypothesis testing. We have 45 minutes left approximately. Okay, hypothesis testing. There's always a null hypothesis, which we call H0, and then H1 or HA is always the alternative. And so it's the process of making judgments for a larger group based on a smaller group. Like I said, you will not always have access to the whole population, so you usually do a sampling. We always test for HO, for the null hypothesis. So if you accept the null hypothesis, by automatic, you will reject the alternative hypothesis. So we always test for HO. H1 is just the opposite of what it is we're testing for. So with null hypothesis, we usually assume there's no statistical meaningful relationship, and so we want to accept or reject. They are always mutually exclusive and collectively exhaustive. It means if you look at the whole possibility of outcomes, do I go out today or I don't go out today? Do I like you or I don't like you? I can't like you, I not like you. Okay, but so some people are in those kind of relationships where they can like and not like. So let's say, did it rain today or did it not rain in my area? It can't be both. Right? Did I eat rice this morning or did I not eat rice this morning? It can't be both. So that's what it is. If I have 100 naira and I want to invest it in one stock, can I invest it in this and this at the same time. No, because I have 100 naira, I want to invest it in one stock. So it means it's mutually exclusive, and you look at the total possibilities of outcome you can have. So a one-sided hypothesis says you want to test whether something is less than or greater than. Is my return going to be less than 5? That's a one-sided hypothesis. Is my return equal to 5? That's two-sided. Means it could either be, if it's not equal, then it's either this or that. So that's basically the difference between one-sided or two-sided. So we have tests we use to test for null hypothesis. We'll come back to this slide. Okay. So one very easy question to get that you don't need a calculator for is what's type 1 and what's type 2? Can someone tell me what a type 1 error is? And someone else will tell me what a type 2 error is without looking at your notes. Can someone tell me what a type 1 error is and what a type 2 error is? Is there though? Yes, he's looking at you, right? Okay, so I struggled with this at a point. How do you remember? Type 1 is reject a true null hypothesis. Type 2 is fail to reject a false non. Let's speak English. If you're on the exam day, how do you remember which is which? Let's speak English. So when we say fail to reject, we're saying accept, but we usually don't say accept, we say fail to reject. Just remember it's accept. That's by the wayside. On the exam day, how do you remember what's type 1 and type 2? So today is Sunday, right? I would assume you should have gone to church if you're a Christian. And so I'm a Christian and I'm supposed to preach the gospel. I believe Jesus is the Son of God. If I tell the world does not believe that, means they reject the truth. That's type 1. I don't know if I communicated that clearly. So if you're not a Christian and you believe in a different kind of deity, please put yourself in my shoes. Like I said, if you're not a Christian and you believe in any other kind of deity, put yourself in my shoes. So we have a mandate to say whatever we believe in is true. But then an atheist says, I don't believe you. That's type 1. He's rejecting the truth. What does the atheist believe? Type 2, he believes a lie. That's basically the difference between type 1 and 2. I don't know if that example will help. Did I communicate with that example? Say it again. Okay. So like I said, I'm a Christian, a Muslim, Buddhist, traditionalist, whoever believes in God, I'm speaking to you. You're sitting on exam day and you tell people the God I believe in is true. An atheist says, no, that's not true. He has rejected the truth. That's type 1. Instead, the atheist believes a lie that there is no God. That's type 2. So type 1 is you reject the truth, reject the true null hypothesis. Type 2 is you accept a lie. You fail to reject a lie. And so in this case, lie I will call negative, so it's a false negative, and truth I'll call positive, false positive. That's what it is in a nutshell. Clear? Reject the truth, accept the lie. Yes, thank you. So just remember, I believe in the deity I believe in, and I tell someone about it, and the atheist says no. That's type 1. Type 2 is he believes a lie. So that's what type 1 and type 2 are. So coming back to statistics, p-value is the smallest level of significance at which we reject H0. Like I said, we always test for H0. Whatever happens to null hypothesis, the other side will be the case for H1. And so we will want to minimize errors when we're making these judgment calls. And so alpha is we want to keep alpha as low as possible, which is the probability that we'll be rejecting the type 1 error. That's type 1 error, rejecting a true HO. So what's the rule? You will have to use a T statistic. If the T statistic is greater than the value you reject HO, if the T statistic is less than the critical value you fail to reject. So let's there's F test, there's some distributions on this side. I had an example about wolf or no wolf, but I'll let that slide because I've already spoken to this. So let's see. Do you want to try your hand at this? We have 30 minutes left. Maybe I should just show the answers. We have 30 minutes left, and I want us to touch on linear regression a bit. So maybe we should move on from here. Parametric test of independence. Do we spend time here? Yes or no? You need to know the formula. The yes, is it that we should spend time here or that we should move on? Spend time. Okay. So this is a continuation of what we were discussing before about hypothesis testing, right? And so you've been asking about formulas. You need to know the formulas. They're not going to give you formulas on the exam day. And so you have to, the only way to know the formulas is to solve. So as much as possible, consolidate what you know and try all the questions you can get. That's the only way for these things to stick. You need to solve. So this is a continuation of what we were discussing before about the null hypothesis and the alternative hypothesis. And so I had said before that correlation is correlation divided by standard deviation. I think that should be covariance. And there's a t-test. So I had said that you calculate the t-value and then compare it to you usually be given that t-value. Or they'll screenshot a portion of a table and give it to you and say, what's the t-value? So you're comparing what you calculate to what's in the table to know whether to accept or reject the. Am I moving back? Yeah, so we're testing for HO, as I've said before. We've talked about the false positive or negative. Have we not done this before? No, we've not. Okay. And so, is there a specific question on this? How's that? You'll be fine. Okay, so I didn't have any questions for this. So let's do simple linear regression. I hope I'll be able to bow out and then give you time to ask me to go back to any specific areas you had. So do we remember linear regression from when we were younger? Y is equal to A plus BX or Y is equal to MS plus C. Do you remember that? It has come back to meet you in your older age. We do. Nice. So that's what regression is. That's where we're starting from. If you solve the maths for anybody doing homework, this is where we start from. So before we start talking about betas, this is the building block. Y is equal to Y is equal to A plus BX, Y is equal to MX plus C. And so Y is what you're trying to find. X is what you know. B is the coefficient of X, and A is the intercept. So let's see. So now we're moving on from small boy mass to big boy mass. And so we're replacing A and B with beta 0 and beta 1. Basically, that's what it is. And so I've said this before. Y is the dependent variable. So Y is deriving its value from X, basically. B0 is a constant or is an intercept. It doesn't change. If B0 is 5, B0 is always 5. B1 can change, X can change, Y can change, but BO doesn't change. E is an error term. Because we're making assumptions, we will sometimes be off the mark. And so the error term accounts for that difference in what it is in actual and what we're predicting it to be. So let's use, we're discussing simple linear regression means is we're discussing straight lines, no bent lines, no sloping lines, no patterns. We're discussing straight line, straight and simple. So what we're saying is that y is equal to b0 plus bx plus beta 1x. If, for example, we say y is equal to 4 plus 2x, it means that if x is 0, then 2 times 0 is 0, it will go, y will equal to 4. So that's why the line intercepts y axis at 4. And so what does 2 represent? 2 means that for every time x changes, y moves twice. So if you look at the y move, x move from 2 to 4, but y move from 8 to 12. So the difference for x is 4 minus 2, which is 2. The difference for y is 12 minus 8, which is 4. So for every time x takes a step, y moves twice. That's what the coefficient of x represents. So I think this might be too simple for you. Okay, let me speak to the last chart on my right-hand side, bottom right. So this is where error terms come in. Because we know that nothing is perfectly straight. There will always be bendy from time to time. And so what we're saying here is the line you're seeing is the regression line. Y is equal to 4 plus 2x. That's the regression line. That's what we predicted. And the yellow dots are actual. So what we're saying is, how does the actual vary from the regression line we have come up with? And so why do we do a regression? We sometimes want to forecast ahead. What do we think returns will be next season? If I have a chain of 3 stores, where do I cite my 4th store? If people come back towards the end of the year and they come back with USD and GBP, you would expect that the rate should crash at that point. Should I wait till then to change my FX? So, it helps you decide what, no, that's seasonal though, so don't use that example. But it helps you decide what to do at what point. And so, like I said, the blue line is what we've plotted as our metric to say this is what we're going to use to predict future values. And the dots on the graph represents actual. And so there will be deviations from the actual from time to time. That's where E comes in. So simple linear regression estimates the linear relationship between a dependent variable and a single independent variable. You can have multiple regressions. So then you have more than one independent variable. In this case, we're dealing with a one-to-one mapping. And so the independent variable is X, the dependent variable is Y. There's an intercept, I've spoken to that. There's a slope, I've spoken to that. I showed you seasonality, that's that graph you're looking at to see there's the line. But then you see that the values are oscillating a little bit. It's trending upwards, yes, but you see it's when it goes up a bit, then it comes down a bit, then it goes up a bit. We call that autocorrelation. So there's some assumptions that you make in linear regression, and one of it is that the residual values, the regression residual values should be the same. This graph shows that they're not the same because one is predicting the other. We don't expect that to happen. And so some of the assumptions are that there should be a relationship between the dependent variable and the independent variable, and that relationship should be linear, straight line, no looking to the left or right. The variance of the regression residuals should be the same for all observations, which is why I showed you this chart to see that there's some seasonality in this data, and therefore that homoscedasticity doesn't hold. The independence of errors. The observations are independent of one another, means they are not correlated. And then the residuals, which is the error, should be normally distributed. And so you have some more formula you need to know. We will track back and forth. You should know this, some of these formulas, all of them actually. You can also use your calculator to compute this to a point. So analysis of variance is the statistical procedure for analyzing the total variability of the dependent variable. In other words, what am I forecasting y to be, and what is it? In actual, if we're in Q3 2024, if in January 2024 I had a forecast to say the amount of rainfall by Q3 2024 will be so and so, let's say 5, for example, and now that we're in Q3 2024, we're seeing that it is 12. The variance between the 5 and 12 is what we're trying to analyze. So that's what analysis of variance is in a nutshell. And so you have some very fancy things you need to know. I'll bring your attention to the right-hand side. This will help put things in perspective. Specifically, we're looking at the bottom right. Can I get a thumbs up that there's still someone tracking with me at this point? Thank you. Okay, so like I said, you need to know there are a lot of things you need equations to memorize, but let's talk through the concept. I've explained what linear regression is. You want to find the relationship between x and y, and x is a predictor of y, basically. So now there's a table you're going to find in the text in the CFA curriculum. And so I just wanted to speak to the English here. So you have that line, that's the regression line, and you have the error, which will come up because you will not always perfectly predict what will happen. So if you sat this time last year and they asked you to predict what inflation will be in Nigeria, I doubt anyone will have got it right. So the difference between what your predictions were last year and where we are today is the error, which is not explained by anything else. And so there's now the total. So if you open up, I don't know if you guys have your curriculum handy, you can open up to where this table is in the text, and then I'll just talk through. So if you understand the concept, it will be easy to yeah, we can do it on a calculator. Gideon. We'll come to that when we're doing the practice questions. So in plain English, right? I've explained what regression is, what the error is, and what total variation is. So regression is what you can explain by, no, I didn't get that right. Regression is what is the variations from the line. Error is what you don't even know what happened. I mean, we don't even know what's going on right now. That's what error is. And then you have the total variation. So the sum of squares total, I'm coming back to statistics now, is the addition of the sum of squares regression and the sum of squares error. Means what portion does the regression line account for, and which one is just due to chance? We just woke up one day and saw XYZ happened. That's due to error. We can't account for that. There's no modeling that would help you do that. The protest, for example, wasn't planned in January. So anyone who was modeling how to move, or who was saying I was going to go to Abuja on certain days, the protest will have distorted your activities. That's common 100% chance. That's what the error is. So the degrees of freedom are how many variables are we, how many independents are we looking at? So for simple linear regression, we have K is the number of coefficients. We have beta 0 and beta 1. I had said before that beta 0 is a constant and B1 is the slope or the coefficient of X. And so we have two regression coefficients. The degrees of freedom for regression is, for simple regression is 2 minus 1, which is 1. So we'll always assume it's 1. We don't need to think about it. I'm just talking through. I'm looking at the upper half of the table. For the errors, it's the total universe of observations minus number of regression coefficients. That's n minus 2. So n minus 2 plus 1 will give you n minus 1. That's total degrees of freedom for this. And so this is sum of squares regression, sum of squares error, sum of squares total, mean sum of squares. So the reason why it's like this is if you plot, you have to plot this table in your head. Mean sum of squares is the sum of squares divided by the degrees of freedom. So for sum of squares regression, it's sum of squares SSR over 1, which is the same thing. For mean sum of squares errors, is SSE divided by the degrees of freedom, that's n minus 2. And then that F statistic, which is a good thing, is MSR over MSE. I hope that this graph will help you know how to walk through when you have to answer the questions. And so we come back to statistics. You see the table at the bottom of the screen. And so let me take you back to the top. Exhibit 19. If you say this thing is getting a bit too much, I'm not sure where we are and what we're discussing. Sum of squares is how do you deviate from what you know? So that's basically what it is. What accounts for the deviation? When I plot and I predict a value in August, I'm predicting that maybe price of rice will be maybe 5,000 per bag. Okay, let me be more realistic. Maybe 50,000 naira per bag in December, and we get to December and it's 20,000. What accounted for the variation? Did they open the borders and say people bring in rice from outside the country, or what changed? Did a new player come into the market and crash prices? So that's what we're checking. So some things are due to the deviations from the line, and some things are unexplained, like them opening the borders, for example. I would not have been able to model that when I was predicting that rice was going to be 50,000 naira per bag. So that's what I'm speaking to at this point. I've spoken about this before. I'll just touch on the bottom right briefly because I have 20 minutes left. And so if you're looking at a log lane model, remember the formula is y is equal to beta 0 plus beta 1 plus beta 1x. So if you keep that in your head, my eyes are closed right now. You have y is equal to something something x. That's the way it flows. It goes from y to x. And so when you see a log lane model, it means the log is the y, and then it flows to the lane, which is x. If you have a lane log model, same thing. Y comes first, that's the lane. The log model comes second. The log portion comes second, which is x. And then if it's log log, it doesn't matter. They're both log. So if you keep that in mind, just keep that in your head, like I said. The one on the left-hand side is the y, and then we say is equal to something something x. It will help. So I want to explain in statistical terms. The log lane model is if the dependent variable y is logarithmic and the independent variable is linear. And so it's the other way around. So just remember y, then x in the formula. That should help you if you're having issues on the exam day. And so we have some practice questions. And we have 20 minutes left. If we round up, if there's any portions you want me to go back to, I can. So can I get a thumbs up if anybody wants to try, or should I just go ahead and publish the solution? Am I audible at this point? Daniel says post answer. Some people are trying it out. Let's see what they come up with. Stock returns dependent, that's correct. No, corporate earnings is not dependent. That's wrong. Totally. Okay, so let's try number 2. We'll talk through one in a bit. Okay, so let's see. So an analyst is researching the relationship between corporate earnings growth and stock returns. Specifically, she's interested in whether earnings revisions are correlated with stock price returns in the same period. She collects 5 years of monthly data on earnings per share revisions and stock price returns for a sample of 100 companies. What are the dependent and independent variables in her model? She's interested in whether earnings revisions are correlated with stock price returns. Did you catch that? She's interested in whether earnings revisions are correlated with stock price returns. So what she wants to check is if stock prices move, what happens to earnings per share? In other words, the stock prices are, did I get that right? The dependent variable is monthly stock prices, and the independent variable is earnings per share over stock prices. Because earnings per share is earnings over share price. Earnings per share. Okay. So dependent variable is stock prices, and the independent variable is earnings per share. In the analyst model, the variation in monthly stock prices returns is being explained by the variations in earnings per share. Okay, are we good with that? So let's move to 2. An analyst is investigating a company's revenue and estimates a simple linear time series model by regressing revenues against time. She plots this. Where's the question? Okay, based on this, describe the assumptions. The question is here, right under the exhibit 18. Based on exhibit 17 and 18, describe which assumptions of simple linear regression the analyst model may be violating. As you can see from exhibit 18, it's bent, so that's all shades of wrong. And we can see from exhibit 17 that it's oscillating slightly around the regression line. That's also all shades of wrong. So we will see that this is not a simple linear regression. The data does not support simple linear regression. So the correct model is not linear. As evidence from the pattern, the earlier years 1 and 2. So you see 1 and 2 are above the line. Then after that, it goes beneath the line for exhibit 17, and it goes ahead again. So it tells you that there's some sort of seasonality in that one. So that means that the residuals, the variance of the residuals are correlated. That's a bad thing. So it's not homoscale, that's TCT compliant, basically. And then it's not normal. We can see exhibit 18 is an upside down, looks like a cup. And so then the sample size is 15. That's too small. You know, I said that eventually, as you get more and more observations, everything tends to normal. But at 15, chances of you having a normal distribution are very low. We have another set of questions. Do you want to try this, or should I speak to the answers directly? Speak. Okay. Explain. All right. Okay, so analysis is exploring the relationship between net profit margin and R&D expenditure. He collects data for an industry and calculates the ratio of R&D expenditure to revenue and net profit margin for 8 companies. Specifically, he wants to explain net profit margin variation by using the variation observed in R&D spending. He reports the data in Exhibit 8, what is the slope coefficient for this simple linear regression? So right-hand side is where the answers are, left-hand side is where the questions are. So the slope coefficient is minus 1.3. We'll see y below. Before we speak to y, let me take you back to where the formula is. Or if your book is open, you can check. But so let's look for where remember the slope coefficient is beta 1. Let's go back to where the formula for beta 1 is. Yeah. Top right hand. Do you see the formula for beta 1? I need a thumbs up or no? Yes, thank you, Solomon. So that's the formula. Like I said, you can't run away from these formulas. You just have to know them. So formula for beta 1 is covariance of x and y divided by the variance of x. So you will notice that there's a relationship between beta 1 and r. They're very close. The formulas are very close. So if you look at the first white box and then look at the second white box, you see that they're very close. The numerator is the same, covariance of x and y. The difference is the denominator. Beta 1 is variance of x, while r, the correlation coefficient, is standard deviation. You know, I've told you that when we talk of correlation, it's always covariance and standard deviation. That one goes without saying. You should know that by now. If you don't take anything else from all I've said, please remember that covariance and correlation are 5 and 6. So the difference between beta 1 and the correlation coefficient is just the denominator. One speaks to the variance of x and one speaks to the standard deviation of x and y. And so the question that we're going to go back to, see the formula. You're adding all the variations of y times all the variations of x and divide by all the variations of x. I'll take that again. All the variations of y multiplied by all the variations of x from the mean divided by the variations of x squared is what we're looking for. So let's go back to that question and see. So if you look at it, the last column has the variations of y times the variations of x added up. The sum is minus 39. So that's our numerator. The denominator is each individual x deviated from the mean squared, which is 30. So minus 39 divided by 30 is minus 1.3. So shows that as long as you know the formula, this is something you can answer in a heartbeat, basically. Do you want me to take that again, or should we progress? I have 9 minutes. Okay. You can use a calculator, yes. So let me just show you that. I think we might get to it though if we have enough time. So if you open your calculator, like I said, the first thing you do every time you pick up your calculator is do that second function clear. You will see if you do second function start, that's 8 on your calculator. Second function number 8 is start. It takes you to that environment, the statistical environment. So you have options of, I don't know what you see, but so mine currently is set to lean. That means it's a linear regression. When I started before, it was set to one variable. So if you do second function enter, in other words, you're pressing set. If you keep doing that, let me start again. Your calculator is on 0. Second function start. It takes you to the statistical environment. Second function enter. You see it keeps changing from power to exponential to 1 minus v. That's one variable. It shows you lean, that's linear regression. It shows you LN, which is log normal. Can I get a yes that somebody is tracking what I'm saying right now? Lean, okay. Thank you, Afolabi. So you will want to make sure that if you're using your calculator for linear regression, you must first of all set it to lean. I made the mistake when I was preparing for this to use the 1 minus the 1 variable. And so I was keying in answers and it was seeing my y as frequency. It was giving me all sorts of wrong answers so that you don't start sweating inside AC. Please ensure that the settings are right. Always check second function start, second function enter. and then keep pressing enter until you see lean. Stop there. You're in the right environment. And so how do you key in figures? Second function, number 7, is data. It gives you x01, y01. If you key it in, you see x02, y02. So you can keep keying in the left and right like that. It will give you the standard deviation, the sum of squares, and all of that. So that would save you some time. If you're working with one variable, then you would switch to the 1 minus v, and then the y will be 1, 1, 1 throughout. I hope. Yes, okay, thank you. So calculator is your best friend when we're discussing things like this. So let's move to number 2. What's the intercept for this regression model? You know, I've told you before, y is equal to beta 0 plus beta 1x. So we have beta 1, that's minus 1.3. We're assuming the mean for x is 6.5. Look at average. I'm back to exhibit 9. You have companies 1 to 8, you have the sum underneath, and then you have the average beneath that. So the average for x is 7.5, the average for y is 6.75. So y is equal to b0. Assume x is 0, that's 6.75 minus, what do I say? Let's go and find that formula. Aha. B0 is equal to y bar minus b1 x bar. So the average of y, mean of y minus b1 x bar. Thank you. And that's what we did here. Y bar is 6.75 minus b0 times x bar, and that's 16.5. Next question, what's the regression line? Easy. Y is equal to 16.5 minus b1, 1.3x plus the error. Let me see. I don't get. What do you mean by, are we using lean because it's in percentages? Can you rephrase the question, please? And then pairwise correlation, there's a formula for R, which I said was correlation divided by variance. And so that's what you see here. Minus 39 over 7 divided by the standard deviation of x and the standard deviation of y. Standard deviation of x is x minus x bar bracket squared divided by n minus 1. Let's move on. I have 4 minutes. Let me see how many more questions. I still have 2 more questions. Okay, so I have 4 minutes left. Let's do coefficient of determination quickly. You know, I had shown you this. It's SSR over SST. That's what it is. So Julie Moon is an energy analyst. She ran a simple regression exploring variations in this. Total variation is 140.58. That's SST. Explained variation is 60.16. That's SSR. That's the amount of variations that are attributed to the regression line itself. And so what's the coefficient of determination? It's just 60.16 over 140.5. We still have a bit more to do, but I have 3 minutes left. So let me pause at this point and see, is there any one thing you would have wanted me to touch on in the last 2 minutes before we round up? Someone says parametric tests. Standard error of estimate. Standard error of estimate, Shegun, is standard deviation of the residuals. So the lower the standard error of estimate, the better the fit. It means the amount of errors you're reporting is low. That's what you see on the top left-hand corner. And it's the square root of MSE. You know, I had showed you this before. MSE is here. It's SSE over n minus 2. I hope that helps. Shagun, is that fine? Parametric test. Okay, Shagun is fine. Okay, so with 2 minutes, Tolu, I'm not sure what it is in parametric test you. Y cap. Y cap is what you're estimating from the regression line. It's the estimate that your regression line is throwing up. That's what Y cap is. So when you plug in, let me use this one we did here. Yeah, so if you look at the regression model, y is equal to 16.5 minus 1.3x. Any value you get for y here is y cap. That's what it is. It's the estimate of your dependent variable. And I have a minute. I'm going to stop at this point. Thank you very much, everyone, for listening. I wish you success. I have a congratulations. Yep, congratulations in advance. And thank you, Yemi. Back to you.
Thank you so much, Oluwatoyin Boye, for the smooth delivery of quantitative method. Next up is a 1-hour break, and we'll reconvene after the break to discuss the income at 2 p.m. Thank you, everyone. Thank you once again, Toyin.
Thanks.